by around midnight or shortly after midnight. They plan to post 30.
All right, what's up, Wealth Squad? Welcome to Stock Market 101.
What's up, y'all?
Today we're going to basically talk about what the stock market is. I wanted this to be basically like a beginner's class for people that's in the Wealth Squad that have no idea what the stock market is. I know sometimes like we send out these alerts, or you may receive like an alert for like a buy signal, and you may think like, what is this? Like, I have no idea what this is. So and you may be interested in, you know, getting into the stock market, making some money, whether it's long-term investing or just trading or buying options, buying and selling options, whatever it be. I wanted to start this up. I know in the previous weeks we were kind of learning about e-com and everything like that, but I kind of wanted to switch it up so that we can start learning about something else. So as I was saying, like today is just going to be the beginning. So what I wanted to do is I wanted to start at a beginner's level for people that have no idea what the stock market is. And then I want these classes to be kind of like a progressive thing where we start at the beginning and then we continuously learn more and more and more about investing in the stock market, different types of stocks or companies that you can buy, different type of ways that you can invest your money into the stock market. So today's day one. So if you've been investing in stock market for like 10 years or whatever, like I said, we're starting at the very beginning tonight. So you can stick around if you'd like, or you can, you know, come back next week when we go to a little bit more deeper into investing into the stock market. You have anything?
Mm-mm.
All right. Where's the PowerPoint at?
Oh, I just want to say what's up.
Oh.
What's up, y'all? What's up?
Chris says, what's up, y'all?
How y'all doing? Y'all good?
Is this daylight saving time like kicking everybody off their schedule or what? Like this week has been crazy to say the least.
Definitely some getting adjusted to.
Oh, there we go.
It's also weird like watching the video.
Wow. Yes, it was so crazy. Like I'm waking up, going to sleep, waking up at odd times. I'm like, man, what the heck is this?
Yep. All right. You wanna?
All right. Yeah, we're gonna jump straight into it, and then we'll pause with the teaching, and then we'll open up for questions or anything like that. So if you have questions, like as we're learning or as we're going, just jot them down, and then when we open up for questions, then you can come back and ask them. Someone said they woke up an hour early for work. Better early than late.
Okay, let's minimize. All right, let's go.
All right, so as I said, Stock Market 101, this is going to be day one of a progressive series going into investing into the stock market. All right, so basically, what is the stock market and how does it work? So the stock market is basically a web-based marketplace where investors like you and I can come together and buy and sell portions of different companies amongst each other. So just like you can go into the grocery store and you can buy a tomato or a soda, a package of chicken. The stock market is kind of the same way. It's a marketplace where you can go in, you can buy. The only difference I would say is that you can also sell. So you can go in and you can buy and sell portions of different companies. The act of buying and selling is going to be called trading. And the portions of these different companies are called shares or stocks. So basically how it works is companies, they use the stock market to collect money from investors to help grow the overall value of their business. So let's just say if I had a company that was selling what?
Pizza.
Pizza? Okay, was selling pizza, right? Or we'll say cell phones, because that was my original thought. If I had a company that was selling cell phones, right? And every year I noticed that my company is progressing and we're starting to do better. You know, the first year we sold let's just say 10,000 cell phones, and then the next year we sold 30, and then by year 5 I'm selling 200,000 cell phones per year, right? There's only so much that I'm going to be able to do with the money that I'm receiving in from my sales with these cell phones. If I wanted to grow my company at a faster rate, the smart thing for me to do would be to open up my company basically for investors. So instead of me having, I made $200,000 year 5. Instead of me trying to reinvest that $200,000 to buy more cell phones or to come up with better quality cell phones or cell phones with better technology, I can open up the floor to investors to say, hey, my company has been doing well. This is my 5th year. This is what my company has been or how my company has been increasing over the past 5 years. And if you would like to invest in my company, then it will more than likely continue to increase, and you can invest into the company. And then as the company grows, your investment will also grow. So instead of having $200,000 to invest or to put back into my company to buy new cell phones, I can open it up to investors, and maybe then now I have, let's just say $500,000 with the money that my investors gave me. Now I can do a lot more for my company, and now I can grow my company a lot faster than just trying to grow it with the $200 or along the same rate from the $20,000 that I made the first year to the $200 that I made at year 5. So I can take that money from those investors and I can begin growing my company at a much faster rate. And that's exactly how the stock market works. These companies, they're valuable companies, and some of them at least, right? Some of them at least. The ones that we're going to invest in are valuable companies. And basically they open up their company, right, to investors like you and I, and they say, hey, here's the opportunity, you can invest in my company. And once it grows, the value of my company is going to grow, the value of your investment is going to grow also, and you don't have to do anything but, invest your money. So that's basically how the stock market works. And once you invest your money, you can take your money out at any time. You can invest your money in the stock market and take it out the next day or the same day, the next minute actually. So, but the portion or your investment with the money that you give the company, they're going to give you basically a portion of their company, right? A portion of the value of their company. That small portion of that company is going to be called a share or a stock.
It's a small certificate of ownership. So you own a part of the company, but you don't own enough of the company to make decisions.
Correct. So boom, you pay the owner of these companies a fee. They give you ownership into this company, a small portion. You let it grow and you let it grow and you let it grow, and then you can sell it if you like and take your profit and go on about your business, or you can leave it in there long term and let it continue to grow. As I said, we're investing in companies that we believe are valuable. So we're expecting some profit. We're expecting some growth. All right, so this slide basically is a visual representation of what I just explained. So we're gonna start at the top left-hand corner. So what is a stock, right? As I said, companies need money to help them grow. So that's where they come to the stock market, and they begin as a private company, and then they become public, putting all their information out there so that investors can see that, hey, my company's valuable and I would like your help in the process of growing it. So they use this money for all kinds of things, like buying materials to make their products, developing new products, building plants, or hiring people to work for them. To raise the money, the companies split their ownership. Like I said, they're going to split the ownership of the company into small little pieces that they call shares or stocks. And then they go ahead into the stock exchange, where you can go in, where traders can buy and sell these different pieces or these different stocks. And that's basically it. That's basically the entire concept of what the stock market is and how it works.
Okay, so you guys all heard of like the New York Stock Exchange, right? So that's the place where all these companies are buying and selling their shares, or where investors can go and buy the shares, right? So you're not necessarily going like to the company's website to buy and sell them. You're going to an exchange where everything is traded. So the New York Stock Exchange is, the most popular one.
Okay. So, and these companies have a set amount of shares or stocks that they're going to own, basically. And if you were to go into the market and you want to buy, let's say you want to buy a portion of Apple or a share of Apple, you'll be buying it from someone. And if you're going to sell it, you'll be selling it to someone, basically.
The buying and selling happens like almost instantly. So it's not like, as soon as you put in an order to buy or you put in an order to sell, you have to shop around and you have to go do the work. Somebody's out there waiting to buy it from you. So the transaction is almost instant.
Okay. Before we go to the next slide, and the way that you would buy and sell in the stock market is through a brokerage account. So it's not like you just type in the website and you go to Apple's website and you're like, okay, I'm interested in buying some stock in Apple. Let me go to their website and buy it. So you'd have to sign up for a brokerage account, and then you'd have to deposit money into that account. And the brokerage account is like a middleman between you or your money, your bank account, and the stock market. So you deposit money into your brokerage account, and then you take that money and invest it into the stock market. And the same thing vice versa. If you wanted to sell your stocks, it will go back into your brokerage account, and then you can transfer that money from your account, from your brokerage account back to the original account that you transferred it from, your bank account.
For the people who are new here that have like absolutely no experience in the stock market, one of the most popular questions I get on social media from like newbies, people will say like, let's say I post like, I made some gains today. Let's say I made $400 today. People will say like, well, can you transfer that to your bank account? Like, so some people don't understand that, like, yes, if I wanted to, I could sell this right now. Then I could, once the money settles, I can transfer it over to my bank account and then spend it, Your brokerage account could even have banking services that you can use. But that's a very common question that I get is like, can you actually spend the money, or can you actually, sell and take that money?
Yeah, I think when you're brand new, you're like, how does it, like, is this real? You know what I mean? Like, especially when you start to make money. And it's easy. I think it's even crazier when you start to lose money that you don't realize that, hey, this is like real money that you made. It's real money that you lost. But like Chris was saying, like, yeah, you can put the money in, you can take it out. And if you put your money in there at the wrong times and you lose money, then you're not going to be able to take it out. That's your money that's gone forever.
So the idea of investing in the stock market, especially in America, it's over 100 years old, but before we became the United States, they're doing this in Europe. It's kind of like a thing. So there's some people here. Maybe your parents were never in the stock market. My parents were in the stock market. So for a lot of people, it's kind of new to us. We're kind of scared. Like, you have to understand, this is something that's been going on since like, the beginning, at least the beginning of the birth of like modern Western culture. So it's been going on for a long time. Companies come, companies go, but they've always opened their doors for people to come invest.
All right, moving on. All right, so how do investors make money in the stock market? So there's two main types of people buying or selling in the stock market. You have traders, and then we have investors, right? So our traders are going to be the individual or we'll just say individual or institution that is going to be going into the stock market, and they're going to buy a stock. They're going to buy stocks when the price of the stock drops to a certain price. And then when the price of the stock rises to a certain price where they can make profit, they're going to sell it, right? So they're buying in at a certain price and they're selling it at a higher price for a profit. That's the only thing that they're wanting to do, right? And then we have investors, right? The second type of person that's investing in the stock market, investors, or you may hear some people call it like a long-term investor. So these investors are going to be buying stocks and they have no intention to sell them in the short term or in the near future. they're holding these stocks as a long-term investment for a longer period of time. I have, for example, 20 years there. And the thing about, I think like a lot of people think that these long-term investors, and you can do this, right? You can invest into the stock market, buy a certain amount of shares in the company and just leave it there for the next 20 years. And you're going to get, you're going to receive a profit just because of inflation. You know, you can buy something, let's just see, that a bottle of water, you know what I mean? Like a bottle of water 20 years ago was probably like, I don't even know.
A lot cheaper than it is
A
today.
lot cheaper than it is right now, right? A bag of chips was, you know, 25 cents, and now it may cost you $1. So just over time, with the inflation of prices, everything's going to go up. It's the same thing with the stock market. So you can buy stocks at a certain price, leave them there for the next 20, 30 years, and then you're going to make money. But a lot of times, and I think this would be the smart thing for you to do if you're going to be an investor to the stock market, and you're going with the long-term approach. A lot of these people, they're buying into a company, but they're not just doing it one time. So they may buy, let's say, 20 shares today, and then 2-3 months later, they may buy one more share or 5 more shares. But over the period of time, they're continuously adding to this investment portfolio. Wait, don't go yet.
I'm not.
Oh, okay.
Let's open up the questions. Go ahead though.
You wanna answer some questions?
Yeah, let's see. Because we can't see the question.
1 second, guys. Bear with us for a moment. Oh, would you mind? No.
Hold on, guys. Let's fix this. Sorry, we couldn't see the chat. Okay. Hold on, guys. Let us. All. Okay. Hey, is the sound better? Everyone should be muted. I apologize for that. Is this better? Good? Okay. My bad, y'all. We didn't realize. We hit the chat while we were speaking. So let's get right back to it.
Want to see the questions.
Yeah, let's keep the comments up, chat up. Okay, so anybody have any questions so far? Anybody completely new to the stock market have any questions so far about anything that we talked about? Some of your questions may get answered towards the end.
Okay, it doesn't look like it.
Okay, so no, we're gonna pick different times every week. We'll just let you guys know in the Discord. But if you have to go or anything, this will be like, we're going to post the link so you can come back and watch it.
All right, so we're just gonna continue on, and then we'll come back and we'll stop and open the floor for questions again. So if you look at the image here, can we move the chat up a little bit? Sorry. Or if not.
That's a good question. Hey, Michael, sorry, Isaac. There's a lot of people who do both. You can do both, but it's important to know when you're buying it into a stock, whether you're trading in this stock or investing in this stock, right? So one of the smart things that people do is they keep different. I don't know why Zoom's always kicking my ass. What's wrong? Okay. Cool. All right, let's go. So yeah, so a good question is, can you trade and invest at the same time? Yes, you can, but you should always know your strategy of what you're doing before you enter it, and then you want to make sure that your trades don't turn into investments just because you held them too long. So before you go into any situation, before you buy anything, you have to, identify whether you're trading or you're investing. But yes, a lot of people do both, and I do both.
All right, so if you look at this image, right, the investing versus trading image, we have two different people here, and they're kind of like at the same desk, and one of them is investing. So the person that's investing, you can see like he's relaxed, his feet are kicked up on the desk. That's because when you're investing for a long period of time, you're not so much concerned on what the price of a stock is doing from day to day or from month to month, you know what I mean? Because you plan on holding this asset for the next 20 years. So if I'm investing in a company and their stock price drops by, let's just say if it's $100 and it drops by $10, I'm not so much concerned because I plan to hold it until hopefully it's, $800, you know what I mean? So I'm not so much concerned on what's happening on the day-to-day. On the other hand, you see the trader on the right-hand side of the screen. He looks kind of like frustrated. That's because you're trying to time the right entry and exit points for the market. So you're trying to time the right points to buy and the right points to sell so that you get the best profit possible when you're trading. So it takes a lot more attention. It takes a lot more, I would say, skill also when you're trading, especially there's different levels to trading, but it takes more skill than someone that's just putting their money in and they're doing it for the long haul. You know what I mean? Whether it goes up or down, they don't care. They're looking at the next 20, 30 years down the line.
Okay, so another thing is there's different styles of trading. So there's day traders or swing traders. So the day traders, so I know a lot of people who ask me about stocks, they say, hey, like I want to invest or I want to trade in the stock market, but I can't have my phone at work, or I'm at work during the market hours. So even if you did want to trade, then you'd probably be better off as a swing trader versus a day trader where you're trying to buy and sell the same day. So there's different strategies of trading, just like there's different strategies of investing, but just know that trading is going to require your participation, like more of your participation. And then investing, it's kind of like a buy only type of thing. You buy in, you buy in, you buy in. It could be, once a month, twice a month, whenever, you have some extra money, you're just buying in and waiting, buying in and waiting. And overall investing, it just pans out better for the average person, just to buy, into an index and just hold it for a long period of time. But if you get good at trading, you can see some quick profits, and this could work as like a side hustle for you.
All right, moving on. All right, so.
Let me get rid of this. Zoom really kicks my ass. Okay.
All right, so how do investors make money in the stock market? So as we said earlier, if you're a trader, basically what you're going to be doing is you're trying to buy a share or multiple shares at a time when the price is low, right? So if you sold your stock on a day when the price of the stock is higher than the price that you paid for it, you would make money. Just like I have a if I go to the outlet right now and I buy if I go to the Nike outlet, I say outlet. If I go to the Nike outlet and I buy a pair of shoes for $50, right? And then in a month, these shoes are selling online for $150, right? That's more than they were selling for at the time that I bought them for. So if I sell them then for $150, then I take that $100 profit, right? So the stock market it works the same way. If you're going to be trading stocks, then you're looking to buy the stocks at a cheap price and then wait for the price to rise, and then you would sell it for a profit. So this is Alibaba stock, right? Also, it says if you sold your stock on a day when the price of the stock falls below the price that you paid for it, you're going to be losing money. So if I go buy those shoes for $50 and I'm like, man, I want to sell these shoes. I need my $50 that I paid for them, right? I need my money back. And then I go online, I look and I see that the shoes are only selling for $40, but I need this money, so I need to sell the shoes, and I sell them for $40. I'm going to be taking a $10 loss, right? Because I'm selling them for less than the amount that I paid for them. And that's the same way that the stock market works. So I always tell people that, because people always say, how much money should I start with? Like, how much money should I start investing in the stock market with? I always tell people that you start with whatever amount that you're comfortable with not worrying about. So if you have $500 to your name and you put it in the stock market, and then you have an emergency or you have a bill come up and you're like, man, I need that $500 back, but the price of the stock is less than it was when I invested my $500. You know what you're going to have to do? You're going to have to take a loss because you absolutely need to take your money out, and you don't have time to wait for the money to rise high enough for you to make a profit. So I always tell people, the amount is different for all investors. You know what I mean? Like everyone investing in stock market, and start with a price that, or a amount that's comfortable for you. Don't just think that you're about to invest all of your savings into the stock market and get rich quick. Get rich quick, because it's less likely that was going to happen.
So I personally started with $35. That was my first investment in 2011.
Yeah.
I was investing in some mining corporation in Arizona, AZC. That was their ticker symbol. They were trading for like $4.30, and I invested like $35 into it. And I was like, oh, and I was watching that thing every day to see what would happen. I had no idea what I was doing.
Just looking, you know. And if you're just beginning, right? If you're just beginning, you wouldn't want to start with like a large amount of money, you know what I mean? Because you don't really know what you're doing yet. You know, you kind of want to get the hang and the feel of the market and how things work. So this is a chart. It's Alibaba.com, right? And we're just going to show you basically how it works when you're trading, right? When you're buying at a certain price and you're selling at a higher price for a profit. So this is on July 6th of this year. Alibaba was selling one share of their company for $220, right? So if you went into Alibaba and then you bought, let's just say 20 shares, right, at $220. And then you waited until, when was this? It looks like on the
13th, maybe.
The 13th or the 10th? It looks like the 10th, right? So if you waited until the 10th, so that's only 4 days later, right? You waited until the 10th, 4 days later, to sell your shares. The share price rose from 220 to 260, right? So then you can sell these shares for a $40 profit per share. Man, I hate that that's cut off. But basically, if you get $40 per share and you own 20 shares, that's the $800 profit that you made in the matter of less than a week, right? Less than 7 days. And that's what we're going to be teaching you guys tonight, right? Basically, to enter the trade at the best time. So basically, you want to find the best point to buy the shares and the best point to sell them to like maximize your profits.
Okay, I have something. I have something I want to ask people. What have you guys? Let's talk about what have you guys heard about the stock market? Um, okay, what have you guys heard about the stock market? If you're new, it always trends upward. You need a lot of money to make a lot of money. It's evil. Good. It takes a long time to build wealth. That it's a big risk. Okay, stocks only go up, you will lose. I always thought it was really difficult to get in. Be careful when you buy low. It's gambling. You will lose your shirt and your shoes. It's gambling. You can make $35,000 in 1 month.
Dang.
Losing money that is manipulated. It's only for rich people. It's only for wealthy people. This is gonna crash when the new president goes up. Look, there's so many things that people heard about the stock market. It's rigged. It's better than savings account. So look, look how drastically different that these responses are. Some people are like, it's a gamble, and some people are like, you can get rich quick, and some people are like, you know, there's so many different ideals about the stock market, you know, and a lot of it is based on the exposure that you had to it in your lifetime.
Right.
And for some people, you know, this year might be the first time they've even heard about the stock market. And for some people, your grandfather might have taught your father, and your father might have taught you, you know, so everyone's at a different level. There's a lot of things that go around about the stock market. And one of the biggest, so some of the biggest misconceptions is that you need a lot of money to get started, that it's gambling. Stocks, you could gamble in the stock market, but you don't necessarily have to. You get what I'm saying? Like, let's see. That there is a successful strategy. Oh, there is a successful strategy for everyone. That's very true. It's volatile, but it builds wealth. Yep. It's not quick rich. Get rich quick. It's better than savings account. So there's so many different things that people hear about the stock market. So we're just trying to show you guys, like, basically, you know, the basics of it, because a lot of people don't even bother to learn about the stock market. You can learn the basics of the stock market in 1 hour, right? And people will avoid learning for 1 hour for 25 years. They'll avoid it for 25 years, you know?
Yeah.
So just to learn the basics for 1 hour. So I'm a big, so yeah, so the basic things about the stock market is that there's a lot of extremely valuable companies in the stock market. About half of all American households have exposure to the stock market because of most people's retirement accounts, right? Their 401ks. So in your 401ks, you're picking funds that are invested in getting exposed to the stock market as well.
And I realized that so many people don't know that, especially like older people. Like Chris was saying, like my parents didn't know anything about the stock market, neither did my grandparents, but it's been around like all of their lives. But one thing that people make sure that they do, that they've worked on the job for like 20, 30 years, they make sure that I gotta invest into my 401k. Like, I'm not gonna miss my 401k investment, or I'm not touching my 401k investment. They feel very strongly about that. And they don't even know that that money is being invested in the stock market. They have no idea.
Yeah. So that's a big thing. A lot of people don't understand that the 401k is being invested in the stock market. And a lot of people also don't understand that not everyone, but most people have exposure to the stock market because of their 401ks, right? So it's not something that rich people only do. Like the common everyday guy, like, you know, the manager at Walmart who's been there for 10, 12 years, like, probably has a retirement plan with Walmart, and their retirement plan is attached to the stock of Walmart, you know? So a lot of people are affected by it. So this isn't something just for Republicans, guys. I know everyone thinks that, like, it's something that the Republicans care about. Okay. One thing I want to tell you guys about the stock market is that you do pay taxes on your gains, right? So like in this example that Crystal showed you, where you buy something for $220 and then you later sell it for $260, you're going to pay taxes on that, right? We're not going to go too far into taxes, but that's a capital gain, right? So you have to pay taxes. Same thing when you receive dividends. Those dividends are taxed. Now, the reason why I bring this up and I say we're not going to talk about this too much, but we're going to jump on it, is because a lot of people who don't have exposure to stocks and business and things like that, they tend to not get involved in these things because you have to pay taxes on it, right? So let me tell you something. So what do you think is better? Me making $1,000 and having to pay, let's say, a 20% tax on that $1,000, or me not making $1,000? You get what I'm saying?
Mm-hmm.
So a lot of people will stay away from things because, oh, you got to pay a tax anyway, so it's not worth it, right? And you're like, yeah, but me paying, 15, 10%, maybe even 20% on a capital gain is better than not having anything at all.
Right.
Okay, so cool. We're gonna keep moving along, but so here it is. Here's the chart, and Crystal's gonna take back over. But I want you guys to know that a lot of misconceptions are based out of fear, and then a lot of people don't even realize how big the stock market is and how not everyone, but about half of all U.S. households have some type of attachment to the stock market. Find a better way to do this. There we go. Okay, so you want to break down, or you want to go to the next slide?
Yeah.
Okay.
All right. So as I said before, there's two types of people that are investing in the stock market. You can be a trader, or you can be an investor, or you can be both. So we just showed you how traders make their money, right? Or how they set themselves up to make profit. They're going to buy the stock at a low price, and they're going to sell it when the price rises to a higher point, right? To take that profit in. So this chart is going to show you what investing on a longer term scale looks like, right? So this is a chart of Amazon. So now Amazon is like super popular. We all know what Amazon is, but 20 years ago, I'm only 28. So I was 8 years old. I didn't know what Amazon was, but 20 years ago, some investor was looking like, man, like this sounds pretty catchy. Like this Amazon company, like this sounds like a good idea. Maybe I should put my money into this. Sounds like 20 years from now, this will be like a very popular company or a very profitable, valuable company. So this chart shows Amazon over the last 20 years, from 2000 to 2020, to today's date, basically. And Amazon has done three stock splits to date. And that's basically when they're splitting the price of their stock to make it more affordable. But if you were to invest $1,000 in Amazon on November 6, 2011, just $1,000, right? Never adding any more money to it. Today, it would be worth $483 and $34 right now. So that's like a crazy return on your money, right? Over the next 20 years, right? From 2001 until today's date. And I always think of, like, when I see this, I don't have any children yet, but when I see this, I always think like, man, can you imagine, like, if you had a child, right, and you were to invest $1,000 into a company that you thought was going to like grow like super profitable over the next 20 years. And when your child was 20 years old, that $1,000 could be $483,000. You know what I mean? I feel like that's like the best savings account that you can have for your children. You know what I mean? Rather than just putting it in or trying to set money aside to put it in a will or something like that. I feel like the stock market is kind of like the best way to go when it comes to that. Okay.
So I have some things. I seen someone ask a question and said, what determines the price of the stock? So when a company, so before Amazon went public and went, opened up to investors, they meet with a bunch of their smart finance people and they determine, okay, we're going to have an IPO. An IPO is an initial public offering. This is them going from being a private company to a public company, right? So they come out with a price that they want to IPO at. Let's imagine this number is, I don't know, $5. So they IPO at $5. Another company might IPO at $100. It's just a number, right? We'll just stick with this. This is just a number that they pick. So that's what happens. It IPOs at a certain number, whatever number the company, so what they basically want to do is they want to figure out how much money they want to raise. So they'll pick the IPO number and then how many shares they're going to issue, and that will tell you how much money you can raise, right? So imagine if I wanted to raise $1,000, then I could have my IPO at $10 a share, and then I would do.
You go.
Right. So that, boom, I raised $1,000. Okay. So, or I can do $100 a share, but I only issue 10 shares, right? So that's how it happens. They IPO when they first come to become a publicly traded company. So what you need to know about companies that are on the stock exchange is basically when you agree to take on investors through like the stock exchange, then there's a list of regulations that you have to follow, right? You have to provide your finances. Your finances have to be open to the public, right? So if you go on Amazon's website or you go on Nike's website, you can go to like investor relations and you can see how much money they made last year, this quarter, last quarter, how much debt they owe. They make all these things public, so that should give you like a good feeling to know that, once you learn how to go read maybe balance sheets or 10Ks or 10Qs, then you can see is this company growing year after year or is it not, right? So that's how the stock price is determined. Like they determine it internally and they want to raise X amount of money, right? The next thing that I want to talk to you guys about is that your stock price the price of the stock doesn't make it a better or worse price, a better or worse stock than the next, right? So if you see one stock is $1,000 for this company, and then another company's stock is $25, it doesn't mean the $1,000 company is a better investment because it's more expensive, right? So I see that a lot, that people think, oh, this company is amazing because their stock is $1,000, like it doesn't matter, right? So it does kind of matter when you get to the low end. You kind of want to stay away from stocks under like $10 when you're just starting off. But hey, look, Amazon was under $10 at one point and now they're worth $3,000. But just because a stock is more expensive, it doesn't mean it's a better company, or just because it's less expensive doesn't mean that it's cheaper, right?
And you don't know how many times, as I said, Amazon right now is $3,241 per share, and they've done 3 stock splits already, right? So a stock split is basically when you split the price of your stock to make it more affordable or to make it tradable at a lower price, right? So if they hadn't done anything at all, any stock splits at all, it would probably be much more expensive. And I say that to say this, as Chris was saying, if you look at, let's just say Zoom, right? The price of Zoom has like increased so much since March, right? Because of the pandemic, right? But who says that people will need to use Zoom in 2030, right? It may not be as needed, it may not be as popular in 2030, but if you look at a company like Coca-Cola has been around for so long, right? So long. They've proven that they're a valuable company. They're always growing, always improving. Over the last 20 years, Coca-Cola has been a profitable company, and their stock price is much, much lower than what Zoom's is. But I would bet that Coca-Cola will be around longer than a company like Zoom would. You know what I mean? And then, as I was saying, I don't know how many times Coca-Cola has split the price of their stock also. So you can't like take these stock prices at face value. You have to kind of like do your research, do your own due diligence as an investor before putting your money into different companies in the stock market.
Okay.
Good?
Yep.
All right, moving on to
every time I see the chat number jump up by a lot, then
okay,
I want
let's
to go
pull it up.
Yeah, I'm gonna go check it. My great grandfather had Coca-Cola back in the day, in the 30s, then sold it in the 40s. Okay, so I'm not sure how people are able to unmute themselves. So let's figure this out. Mute all participants and don't allow them. I think it's when people are coming in, maybe. More. Mute upon entry. Allow them to mute themselves. Nope. Okay, we're gonna lock the meeting. All right, cool. So, all right. So the thing about so this guy Jordan, his great grandfather had Coca-Cola back in the 30s and sold into the 40s. So imagine this: Coca-Cola has been paying dividends, right? So his great grandfather, let's say he owns this this stock portfolio. His great grandfather is getting paid dividends to hold this stock, right? And then his great grandfather passes. And then imagine he passes it off to his grandfather, and Coca-Cola is still paying these dividends, still paying. So not only is the price of the stock going up, but they're also paying a dividend, right? And then let's say his grandfather passed. Sorry, Jordan, if your grandfather hasn't passed. I don't want to wish that on him. And then it moves on to his father. Then it moves on to him, right? So these companies are paying to the ownership of like a portfolio. They're not paying, just to Chris Johnson, and then when Chris Johnson dies, then nothing else happens. This type of stuff gets passed along. It gets passed along from generation to generation. And this is how, when people say generational wealth, like, yo, when I pass away, my children are going to have my portfolio, and it's going to continue to pay. All these companies are going to continue to pay my portfolio, in which my son will have control of, So that's pretty cool, man. So imagine that, for you guys out there who have children, you understand, like, when I have children, my views as an investor change, because I don't have to get rich. Like, I don't have to get rich in one generation. I can build up a portfolio that is set to grow, or maybe I could buy a bunch of shares in, like the SPY or something. And then I just grow it. And then when I'm gone, then my son and my daughter will grow it. And they'll pass that along. So it extends the horizon, because I know the stock market will be here long after I'm gone, So I kind of want to build up these portfolios so I can pass it off. Like, that's so cool that your grandfather, had it. So how do you pass it to your kids? Is it via a will? Yeah, or a trust. You can even put your brokerage account into a trust. Okay, so is there a requirement providing a company's financial on a quarterly basis, or simply common practice for being no, it's a requirement. So it's a requirement for these companies to provide this, their financial information.
Their earnings. And it's done 4 times per year. So every 3 months, right? Every 3 months, they're going to tell you how much money they earn. And basically, you can go online. Like he said, like, most of it is on a company's actual website. So like, you can go to, like you said, to Nike to buy a pair of shoes. You can go on there, and there's a tab that says investors, and it'll tell you basically their financial information.
Okay, so someone said, so a dividend payment is money paid to you directly by a company from their profits for simply owning the stock, and not a portion of your own profits paid to you early. Yes, that's exactly how it works. It's like a thank you, right? So they'll take, let's say this company made $100 million, right? And then they're going to pay some of their bills with that $100 million. They got to pay for their leases. They got to pay for their equipment. They got to pay some debts maybe, and then there's going to be some leftover money. And this leftover money, the board of directors is going to decide, hey, we're going to, we got 60 million left over. We're going to take this money, we're going to take 40 million, and we're going to reinvest it back into new product, new research, marketing, blah, blah, blah. And we're going to take that last 20 million and we're going to dish it out to our investors. So then they're going to say, okay, how many shares are out there? And then they're going to say, all right, well, what we're going to do is we're going to pay everyone 25 cents per share that they own. So if Crystal owns 4 shares, then boom, she has $1. If I own 40 shares, then boom, have $40, right? So that's the way it works. But it's just a bonus, basically, right? So it's kind of strategic in a way. Some companies might want to not pay a dividend and take all their money and reinvest it back into the company, and some might want to split. And some companies, like a real estate investment trust, we'll get into this later, but their purpose of setting all this up is to pay dividends. Like that's their main thing, is to pay dividends out to their investors.
If the company goes bankrupt.
So if the company goes bankrupt, you lose your money.
Yeah, that happened to you once or no?
Twice.
Dang.
It happened to me twice, man. I lost
early investing days.
Yeah, so it was like this speculation play. It was a that AZC, that mining company, I think they went bankrupt, and then there was another medical company that I invested in. I never looked at their finances. These were penny stocks. I think they were worth like, I don't know, AZC was like $4, but the other one was like maybe 37 cents, and I had $1,000 in there. They couldn't pay their debts. They went bankrupt. My money was gone. Boom.
We'll just answer that one. Go ahead. So why do some companies pay dividends annually and some quarterly, and which ones are better to build a passive income? There are some companies that pay their dividends on a monthly basis also, right?
Yeah.
So it's all up to them. It's up to, like he said, it's up to a company to pay a dividend. And if they feel like, you know what, we don't want to pay a dividend anymore, they can decide right then that day, we're not paying a dividend anymore.
But they understand that people are investing in this company specifically for this reason. So if they come out and say, hey, we're cutting our dividend because we don't have the money, then they know that a lot of people might sell their shares, which could cause the price to go down. Right. So when it comes down to
which ones are better?
Which ones are better? The companies that pay quarterly, the companies that pay monthly, right? It really doesn't matter, right? Because if you think about it, if a company is going to pay 5% and they split up that 5% equals, let's say 5% of their yield equals $1, right? So they're paying out $1. So it doesn't matter if that dollar is paid 4 quarters a year or that dollar is paid, over 12 payments. You're still only getting $1. You get what I'm saying? So it doesn't make a difference, man. So for some people, they just like it. It keeps them in the game longer because they know they get monthly checks. And then if you're older and you're actually using these dividends to like pay your bills and stuff, you might set it up where you like companies that pay monthly. But yeah, so that's like about the dividend thing. It's up to the board of directors, like Mike said. The board of directors, they basically control, what's going to happen with the company's finances. Okay, and then we'll get to this one question, then we'll hop back onto the slideshow. So it's better to invest in a stock that pays a dividend and trade stocks that don't pay dividends. I wouldn't necessarily say that. At the end of the day, the only thing that matters is the return on your investment, right? So there's some companies that don't pay a dividend, like let's say Berkshire Hathaway. They don't pay a dividend, and their stock started, like $6-7 a share. Now it's $330,000 a share because they decided that it's basically they can grow their money better for you than you could grow it on your own. So they're not going to pay their investors dividends. They're just going to keep reinvesting back into their company, right? So that doesn't make it a better or worse investment than someone who pays, let's say, a 15% dividend, So it all depends on the return on the investment, right? But when it comes down to long-term investments, I personally like to invest in things that are long-term that pay a dividend, right? And then I even trade stocks that pay dividends as well, and I trade some that don't pay dividends. But you'll have a different investment style. So you might want to invest some of your your income, or some of your investment for growth, and some of it for income, So think about it like the difference between flipping a house and then buying and renting out a house, right? So when you're flipping a house, you're basically like trading stocks, right? You put X amount into it, the work gets done, you sell it for a higher price. That's like trading stocks. Or you can invest, or you can buy and hold, right? So that'll just be like a long-term portfolio where you're just buying and you're just collecting some money. You're collecting some dividends, right? So I would suggest that people mix it up, more growth than dividends while you're younger, but yeah, it all comes down to strategy, right? The ROI is the most important thing.
And ROI is return on investment, if you don't know what that means.
Yeah, sorry.
All right, we'll be back for the questions. We're going to jump back into this so we don't have you guys here all night long.
Chris don't want to have y'all here all night long. Okay.
All right, so which company should you invest in, right? So you know what the stock market is, you know how it works, you know what you need to do in order to make money in the stock market, whether you're trading or investing, but what do you buy, right? So I always tell people that you want to invest in companies that you think are valuable, right? Any company that you would pay for a product or service, or companies that you believe are personally valuable, that's what you're going to invest into. So if you go to Target, you go to Starbucks, you use Amazon, you wear Nike, you're watching movies or TV shows on Netflix, you go and you eat at Chipotle, you're driving a Toyota, you're buying your computer from Best Buy, flying on American Airlines, all of this, right? All of these companies are available for you to put your money into the stock market and for them to grow the value of your investment. So that's what I tell people, look around, like on your day-to-day, look around at companies that you're using for products and services. And if you just don't know what to invest in, go with those. If you think that they're valuable and they're going to be around for a long period of time, then that's what you go with, right? We have real estate investment trusts, or REITs. So REITs are basically going to be like a company that is going to be buying real estate. So you can invest in these companies that are going to be buying real estate. So let's just say a shopping mall, right? So a shopping mall or a shopping center, we'll just say like a shopping center, right? So a REIT may own a shopping center that has a Target and a Starbucks in it, in a Nike store that's in the shopping center, right? So that Target is going to be paying monthly rent to be using that shopping plaza, or Starbucks might be paying monthly rent to do business in that shopping plaza to a real estate investment trust, right? So instead of you investing in Starbucks individually, or Starbucks or Ulta Beauty individually, you can invest in a REIT that may carry those different that may, what am I trying to say? You can invest in a REIT that's collecting monthly rent from these different companies or these different organizations. That's what I'm saying. We have and REITs pay dividends also. But we're going to get into dividends. We're going to have an entire class on dividends at a later date, so I don't want to go too much into it. The S&P 500. So the S&P 500 is it's basically a fund of the 500 most profitable companies in the stock market, basically. And the companies, they change in and out over time. So there could be a company that's like inducted into the S&P 500, and it can be taken out depending on how it performs. But because it's supposed to be the 500 most profitable companies, it's a good indicator of in which direction the stock market is moving as a whole. So if I look at the S&P 500, and I know that this is supposed to be like the 500 most profitable companies, and I see that it's trading upwards, that tells me that these companies are most likely doing well, right? And if it's trading downwards, then that's telling me that, you know, the market overall is most likely going to be on a downwards trend. Go ahead.
Okay, so you guys, so the S&P 500 is it's 500 biggest companies, right? So for people who want to invest in the stock market and don't want to necessarily trade, right? The S&P 500, it's just an index that watches these companies, right? So think about it like a basket, right? So all these companies, you can go invest in these companies individually, or you can invest into an index fund that mirrors the S&P 500. So they go out and they invest in all these companies, right? And it's just a basket. It's like an Easter egg basket with all these companies in it. So for the people out there that don't want to be trading, they just want to put their money away, you know, month to month, and then that's it. Like you take some of your paycheck and then you put it away. You take some of your paycheck, you put it away. You can just invest into like an index, like the S&P 500, right? So if you go on to your Robinhood or your TD Ameritrade or whatever, you search SPY, that's an index fund that mirrors the S&P 500. Now, what's cool about the S&P 500 is there's no 20-year span where the S&P 500 didn't make money, right? So over the course of 20 years, you're up until this point, you're guaranteed to make money, right? Because American businesses get bigger and bigger and bigger and bigger and more profitable. So then what happens is the stragglers, the companies that are in S&P 500, and they start going downwards, eventually they get kicked out, and then you bring the new guys in. So if you don't want to be like a trader, you just want to get started, then simply just find like something that mirrors the S&P 500, like just SPY, or there's another one, VOO, and there it goes. Like there goes your almost your guaranteed path to become a millionaire. I believe that they do. I believe that the year returns is like 10% per year. I think it averages out to 10 or 11% a year, right? So think about this. You could do almost 10% a year on average. So if you have $10,000, that means year one, you make $1,000 on top of your 10, right? And then year two, you're getting 10% again, right? And that 10% isn't of 10,000, it's of 11,000, right? So, and then it just keeps going and keeps going. This is pretty much like the safest, not the safest, but the most common way for people to hop into the market. If you don't want to go searching for individual stocks, you can just invest in the basket itself.
All right, so moving on to the Dow Jones, or the DIA. So the S&P is supposed to be the most profitable or most valuable 500 companies. The Dow Jones is going to be supposedly the most valuable 30 companies in the stock market. And as I said, companies are traded with the Dow Jones. So they're inducted into the Dow Jones, and then they're taken out basically based upon how they're performing. So you may see companies that are, it's in the S&P or in the Dow, and you're like, man, this company's not really performing well. You know what I mean? It may have been like put into the Dow Jones or the S&P 5 years ago, and it may not be doing so well at the moment when you look at it. But the S&P is top 500, Dow Jones supposedly the top 30 companies. So before we move on, which companies to invest in? You can invest in any company that you think is going to be profitable or valuable. You can, if you don't know what you want to invest in, you just want to put your money in the index fund, you can put your money in the SPY or the Dow Jones index.
Oh, and what I was gonna say is what's very important for you guys to know is what you invest in is very important, but equally as important is when you invest into it, right? So we're gonna talk, we're gonna pull up a stock chart and we're gonna show you guys like different indicators, but when you invest into companies is very important. Do you guys remember when everyone on social media was talking about Apple and what was the other one doing a stock split? Tesla. Do you guys remember when everyone, please tell me you guys remember this, right? It was September, leading up to September, right? Everyone's like, yeah, this is your time to go get an iPhone now. This is your time to invest. This is your time to invest in Apple, right? You guys remember this?
I want to pull up the chat.
Yeah.
And if you invest in Apple or Tesla, then just put it in the chat. I want to see.
Yep. All right. So everybody was saying this, right? In a way, I almost feel like people were trying to like peer pressure you into like, oh, you can go buy an iPhone, but you can't invest into Apple, blah, blah, right? Like everybody was saying this, right? And then you know what happened? The day that the stock split, it just started on a downward trend. Everyone who jumped in.
Somebody said it lost $20,000
on Apple. Were you trading options, or did you just invest? Did you just buy the shares? Okay, so yeah, it hasn't gone up since. So what happened was Apple was climbing. The stock market reached a peak, right? And everyone is sitting around telling you to go invest in these companies when the stock market is literally sitting at the top of the top, right? The top of the top. And everyone's telling you, go invest in these companies, go invest in these companies. There's indicators out there that will tell you like, yo, this is like, this isn't a good time right now.
Yeah.
So everybody ignored this because they simply didn't look at these indicators or don't know what these indicators are, right? So I'm here to tell you that when you invest is very important, right? When you enter a trade is very important. When you exit a trade is very important. When you enter an investment, when you exit an investment is very important, right? So think about this. Somebody, they were whipping up a frenzy and Chris was ignoring them. People figuring out, then they dumped. Yep. I kept telling people too, man, stop listening to people. All right. So there's somebody out there that bought Apple 5 years ago. And then there's somebody that bought Apple August 29th, right? And they're in complete, let's say they both spent $500 when they invested. They're in complete different situations right now because one person invested here and Apple went here, and one person invested here and Apple went there. Right. So when you invest is very important. We're going to show you guys some indicators, right? So listen to people, but Chris telling people. Now, what I'm going to do is I'm going to tell you guys what indicators that I use, and then you listen to the indicators because people are going to be flawed all the time. Like, but it's crazy, man. What you see on social media, and social media has a lot to do with this because it creates an echo chamber, right? If everyone's talking about this, everyone's talking about this new company that just moved 100%. And now you're like, is it too late? Is it too late? And then you get into it. And guess what happens when you get in? That shit is going down, right? So it's very important, you guys, very important to know, like, investing, when to invest. Okay, let's move on. All right, when. Okay.
All right, when to buy or sell. So the stock chart is going to tell you when. Not your cousin, not your investment buddy group, not your Twitter guru, Chris Johnson. None of those people are going to tell you when to buy and sell, right? The stock chart is going to tell you when. If your stock chart is telling you like, nah, bro, it's not time for you to buy in, based upon the indicators that we're going to go over today, don't buy it, right? I don't care if someone's telling you tomorrow that this company is going to soar to the moon. They love to say that, to the moon, with the rocket emoji.
Yeah.
That's what they love to do.
And it's not that these indicators are spot on, but they're right so often that you kind of be a fool to like ignore it, you know?
Right.
And remember, you being wrong or you going against the indicator. So if the indicator is right and you're wrong, it's hard-earned money that you're about to lose, right? So you want to be strategic about these things.
Mm-hmm. And if you're listening to someone, right? If someone's telling me like, hey, go and buy into Apple, they're about to release an Apple car in 2 days. I'm really thinking that they're about to release their Apple car and the stock's going to move up. And I go and invest and then they don't, but in reverse, it moves down. There's no way that I can go to that person and say, hey, I lost $1,000. Are you going to give it back to me?
Yeah, like
they're going to look at me like I'm stupid. You know, like you're a fully functioning adult. You have to make decisions for yourself. So as Chris was saying, like these indicators, they're not always spot on, and they're not always in a line with each other. So you may be looking at your moving averages and they may be telling you to buy, and then the RSI may be not in a line with what you're learning right now. So they don't have to all align perfectly for them to prompt a buy or a sell signal. So you kind of just have to use your common sense to look at the indicators on your stock chart and the overall market sentiment, what's going on in the market, in our economy.
So one thing I'll tell you guys about these indicators, and we bring up these indicators, there's a lot of indicators. These aren't the holy grail, but the reason why we tell you guys about indicators and about sticking to a strategy is because it's better to have a strategy and stick to that strategy. And let's say the indicators work against you. Let's say that the indicator, like the RSI, is telling you not to buy something because it's too high. And we're going to show you exactly what the RSI is, right? And let's say that the RSI is saying like, hey, I learned this from Chris. When the RSI is 70, I don't want to buy, right? And let's say that you don't buy and the stock is at $100 and then the stock keeps going up and the stock keeps going up, and the stock keeps going up. And the moment you buy, guess what's gonna happen? Like, everybody in this entire earth can buy their stock, but the moment you buy it, it's gonna go down, right? So it's kind of better to sit on the sideline and watch something run away from you than for you to gamble and take all these chances, because the moment that you are wrong, the moment that you do buy Apple on August 31st, now look, you're down, and you're still down, and we're in November, you're still down, and you could have avoided all of that, right? So yeah, it's kind of better to sit on the sideline a lot of times and just let things play out and wait for these setups. So don't feel like things are running away from you, or don't feel like you're never going to have another opportunity to invest in this company because they're doing so well. Like all the companies that do well, they're eventually going to have a pullback, and then you'll have an entry point, right? So a lot of this is about patience. So while everyone in the world is telling you to buy Apple, you can just look at a chart and say, I'm going to wait. And then 2 days later, when the stock splits and it starts falling, you say, oh man, I'm glad that I waited, right? So,
all right, so the first indicator that we're going to go over is the moving average. So the moving average is just basically the average of the stock's price over a daily period. So whether it's the 5-day moving average, 20-day or 200-day moving average, that's just the average the average of the stock's price over a 20-day period, or a 200 or a 5-day period, right? So if I see that the stock's price is trading higher than, or is being sold for higher than it was being sold over the last 20 days, and I see that the next day it's being sold for higher than it was sold over the last 20 days, that kind of should prompt something in my mind that say that, man, it looks like the price is going up, because over the last 20 days, it wasn't being sold for as much as it is now, right? We have the relative strength index, or the RSI, and that basically is going to measure the speed of change of price movements, right? So if, let's just say, like Chris was saying, like if they're saying like, man, you really need to go and buy Apple, like they're about to do their stock split, and they're going to go to the moon, like the price is going to shoot up. The RSI is going to tell us when this stock is going to be overbought, right? The price is going to be changing really, really fast, right? People are buying into it at a really fast rate. That's going to tell us that the stock is being overbought, and there most likely will be a pullback in the very near future, right? Because like if you think in your mind that the stock may be overbought, then let's just say another investor following the same strategy that you're following, they're thinking the same thing. And in the stock market, everyone's trying to maximize their profits and minimize their losses, right? So what you don't want to do is to go into buying into a stock that has a high RSI that's signaling an overbought signal to you, and those investors that already own that stock are getting ready to sell. Because you know what's going to happen? When they sell, the price is going to start going down, and you are going to start losing money immediately on that investment, because you're buying at a high price and people are selling off, and then the price of the stock is going down, and your investment is losing money.
So it's not that the price went too high up. It went too high up too fast, right? Mm-hmm. So a company can slowly like go from $100 to $200 and never trigger a high RSI, right? But if a company goes from $100 to $200 in 3 days, then the RSI is going to be screaming, you know? So it's not that it's moving too fast or it's moving too far, but it's moving too far too fast, right? And then same thing when the RSI is low, okay? So we're going to show you guys after we talk to you about the MACD.
Right, it measures the speed. So the RSI is measuring the speed. And then we have the MACD, or the moving average convergence divergence, and I never say that entire word. I think everyone just calls it MACD. So the MACD is going to be used to show you changes in strength, momentum, and direction. So it's going to show you changes in the direction of price before any of these other indicators kind of show. So it's kind of like an early warning signal, right? That shows you, hey, the price is about to start moving up, or the price is about to start moving down. It's going to be an early warning signal to show you a change in the stock price's direction, either up or down.
Okay. Oh, you wanna?
Yeah, I want to go. So before we get into that, I just want to pull up stockcharts.com, and I want to
Let's go to stock charts.
just go through some companies so that we can kind of show you the different indicators.
Okay, so let's go. Am I still sharing my screen? Oh no. Hey, can you guys see my screen? Okay, cool. So this is stockcharts.com, right? So if anybody asks me, what do you think of this company? What do you think of that company? What do you think of this? What do you think of that? Guess where I'm going to go? I'm going to go to stockcharts.com. You can use the free version. Some people use TradeView. So there's all different types of charts that look different that everybody uses. I personally like stockcharts.com. If somebody else tells you about some other charts, go check it out. Like, this isn't the only one, right? So I like to use stockcharts.com, right? So what you do here is you can put the symbol here and then the period. So I use a daily period. So that means every single one of these bars here represents 1 day, okay? Or you can, if you want to scale back a little bit, you can see a weekly. Okay, so this will give you, a broader view, but I always set it to the daily. Okay, and then we're gonna go look at Apple. Okay, so you wanna break it down?
I kind of like that other chart better.
What you like to?
Yeah.
Okay.
Or
This is the one that I just sold today.
okay, I'm gonna add the 5-day moving average.
Yes. Do you change? So Izzy, do you change anything on the settings on the chart? Yes. So you see, she went down to the parameters, and she went to exponential moving average, and then she changed it to 5. So what she likes, what we both like, is exponential 5-day moving average, a simple 20-day, and a simple 200-day. Okay, and then you're gonna hit update. Now, these moving averages show as lines here. So you see we have, and they're also here. Okay, go ahead.
It was a question, but I can't remember what it was. Okay, so basically the way that we're going to use our moving averages, we have the 5-day, the 20-day, and the 200-day, right? So we're going to mainly focus on the 5-day and the 200 and the 20-day right now. So when the 5-day,
show them like the lines.
Oh, okay. So the 5-day right here is going to be the green line here on the chart. The 20-day moving average is going to be represented by the blue line on the chart. So the way that we're going to use these as indicators when to buy or when to sell, anytime you see, you want to say something?
Can you zoom in a little bit?
Let's see. How do I do that?
Let's go.
Okay, awesome.
Is this better? Okay, go ahead.
All right, so anytime you see the 5-day moving average cross over the 20-day moving average in an upward or a downward trend, that's an indication that the price is about to go up or the price is about to go down. So for instance here, if you see the 5-day moving average, the price is kind of trading sideways. That means that the stocks are being sold for around the same price for this period of time, right? And we're gonna go over the 4 stages in price movement after we're done with this chart.
Wait, I'm gonna let me throw something in there.
Okay.
Okay, so you guys, the difference. I want to tell you guys something about these parameters down here. The difference between an exponential moving average and a simple moving average is this, right? If A price is if a stock is selling for $10 for 10 straight days, the 10-day moving average is $10, right? Now, if the price is selling for, let's say, the first 7 days, the price is selling for $10, and then on the 8th day, it's selling for $12, and then on the 9th day, it's selling for $15. The exponential moving average is going to put more weight on the most recent days, right? So the difference between the like a strict moving average is it's just the days added up and then the average price of the stock. The exponential moving average gives more credit to the more recent prices, right? So it shows stronger momentum. Okay. Sorry, I just want to add that.
No, that was very good for you to add that in. So basically, like I said, the 5 EMA moves over the 20 MA, and then in an upward direction, that's an indicator that the price is going to go up. So for instance, here, right, the price is trading sideways, and then at this point on this date, the 5 begins to trade higher than the 20-day. And if you can see the price, these different bars, right, represent the stock's price. The price begins to go up at that point. And then it begins to trade sideways again, right? Right here, a little bit, the 5 dips below the 20, and then it kind of recovers the next day. And then it's still trading sideways. And then here, there's a distinct downward trend where the 5-day moves below the 20-day in a downwards trend, right? That lets us know that, hey, the 5 just went below the 20. The price is most likely going to be going down. And it does, right? A steep fall down the very, very next day. It goes down a steep fall and it continues to drop down until it goes sideways again.
Okay. So you guys, I'm trying to like imagine you explaining this to a beginner. You guys understand how to even look at this chart? The dates at the bottom, right? And then the price is on the right-hand side. So if you want to figure out what the price is on, let's say July 13th, right? You just come up this line and you see the price was moving up and down throughout the day on this day, right? And then you can look over to the right over here and you can see, okay, it was, trading between here, which is 132, and down here, right? So you guys get how to read that, right? I just want to make sure. So if the price is going vertical and it's going up and down, it just means that it's swinging throughout the day. This is the highest price it was for that day, and this is the lowest price that it was for that day. Does that make sense?
Yes.
Okay. Okay, cool. Yeah, I just wanted to make sure that you guys were, because sometimes when people pull up charts, I know people who are complete beginners are like, what the hell am I looking at, right? These candles are just representing the price going up and down throughout the day. This is the high point of the day. That's the low point. Sorry, this is the low point of the day. Okay.
Okay, and at the very top here is going to be where the RSI is displayed. And then we have our MACD at the bottom here, our graph showing our MACD. As Chris was saying, the dates are here. Each individual, this is going to be volume. So this is going to be showing the volume here. And then on this side, this is going to be showing the measurement of volume. So you can look at these bars right here, and then this will show you the measurement of the volume. So on this date right here, this looks like, if this bar right here is the 6th of July, then this looks like it will be the 3rd of July or the 2nd of July. You can see that on the 2nd of July, the volume was very high, almost close to 7.5 million. So the volume is just showing the amount of shares that are being traded, either bought or sold in the market that day. What do numbers represent besides the MACD? We're going to get to the MACD in a minute. One second. So I want to go, I just want to stay on the topic of the moving averages. So as I was saying, if the 5-day is crossing over the 20-day in an upward trend, and that's going to indicate to you that, hey, the price is most likely going to be going up. Same thing when price is going down. Here, it looks like it started to cross on an upward trend, and then it didn't. It just bounced back down.
So you notice that happened in one day. Like this little fake out right here happened in, oh, sorry, a 2-day window. So if you're trading in the stock market and you're not looking at the stocks once a day, I mean, what does it really, what does it really like, you know, take you to log on to stockcharts.com? You don't even have to log in, like it's free. Like you just go there and then plug in your even if you're at work, like, yo, just go plug it in. Because what happens is, let's say you buy on a day like this because you think, okay, the 5 just went above the 20. So you think this stock is going to trend upward. And then at the end of the day, it falls, right? Now you know, okay, I need to get out of this trade because I don't know how far it will fall. So, like, you know, take a peep at your trades once a day, you know, like at minimum, at the very, very minimum, once a day. Okay. What I like to show you guys about the moving averages is the 200-day, right? So you always keep the 200-day. So there's about 200 trading days in a year. So this is the 200-day moving average, right? And there, okay, that's a good question. So for the MA20, do we have to count back 20 days when you're looking at the chart, or it highlights it for you, right? Okay, so here's today's price. It's in black, right? If you want to know what the moving average is for the 20, it's already right here, right? 124. You don't need to go back 20 days and do it. They've already did it for you. So here's if you follow this blue line, this is the 20-day moving average, right? So today's price is 142, but the 20-day moving average as of today is 124.19. Does that make sense? D. All right, cool. So this whole line is just following the 20-day moving average, right? So you don't have to count back or do anything. All the calculations are made for you. The black line is what today's current price is. And then this is the 5-day MA. And then this is our EMA. And then this is the 20. Okay.
So someone to explain more. So basically, okay. Go ahead.
Okay. So does that mean during the last 20 days, the price was at 124.19? Yes, that means the average price was at 124.19, right? So check this out. If the price right now is at 142, and we can see that this is the price of today, and then yesterday the price was what? Like about 139, and then the day before that it was trending in the same area between 136 and 141, right? That's 3 days ago. And then 4 days ago it was trending in the same little area. 5 days ago was here, but look, it gapped all the way from here. So it went from here to there, right? So it's putting in the average days for you. So if somebody says, hey, the price just crossed its 20-day on this day, then you'll know this is the price. Sorry, this is the price, and this is when it crossed the 20. The price is above this line. So that's how you know it crossed the 20. If you go back any day, like let's say this day right here, the price fell below the 20-day moving average, right? Does that make sense? Who asked that? Oddness fly. Okay, you got it? Cool. A lot better. Thank you. Okay, so that's what it's doing. It's pricing. It's already built in the calculator, right? So when I say, hey, I'm waiting for the price to move past the 20-day moving average, look at this. Like this price is above the 20-day. So I'm looking at this line, which is the 20, and I'm saying, is the price above this line or below this line? Or is it about to move above this line or below this line? Because this is today's moving average. This is today's 20-day moving average. On September 8th, the 20-day moving average was at this point. You get it? Okay. Why use the 5 EMA instead of the 9 EMA? So basically, this strategy that we're teaching you guys was thought of in 1987 by a dude named Stan Weinstein. And then basically what happens was somebody took his strategy and improved it because stocks moved slower back then. And then a man named Gerald Peters took his strategy and improved it. And basically we're using, so this is like a version of a strategy that was developed in 1987. So this is like the strategy that we follow. So if you were to change this moving average to, let's say, 9 days, right? So you just change the 5 EMA to the 9 EMA, and you come up with your own strategy, and you realize that the 9 EMA works better for you than the 5, then use it, right? This is just like the benchmark because it's from a strategy of a strategy. Okay, so where were you going with this?
That's really it. So that's basically how the moving averages work. So we're going to go to the top of the chart to the RSI. So as I was saying, the RSI is going to be showing you how fast the price is changing, whether it's going up or down, how fast it is. So RSI, the 2 levels that we're going to be looking at specifically is going to be 70 and 30, and they're already outlined for you here on the chart when you set your RSI to a 14-day period. And you can do that at the bottom of the chart here. In the attributes, you can just set your RSI to 14. So anytime your RSI is headed over 70 or close to 70, that's letting you know that the stock is going to be in a overbought state, that you should be, if you own shares and you're trading for a profit, then you should be selling those shares and getting out of that trade, or you should be selling those shares to take your profit. So if we look at the price movement on the chart right here, we can see that as price is going up, the RSI at the top of the chart is also heating up, going towards the 70 mark, the 70 line. And anytime the RSI goes over 70, it's going to give you this green color at the top of the chart. So remember, near or over 70 for RSI, that's going to give you indication that you need to be selling to lock in those profits if you're trading. And then
look, you guys, look what happened. So imagine you own this stock on May 19th, right? You own this on May 19th, and then May 20th comes, May 25th comes, blah, 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 right? Okay, every day the stock is getting higher. It's going higher and higher. You're logging into your account and you're seeing like, man, it just keeps going up. But then when you log into stockcharts.com, you see that the RSI is above 70. So you're like, man, well, I'm making so much money. I want you to think about this logically, because it's easy for me to say this, but when it's happening to you, your greed and your fear are going to kick in, right? So you buy a stock for whatever reason, and it's going higher, and it's going higher. And every day that you log in, you're just watching this stock climb higher and higher and higher. And you're like, man, I'm so happy because I bought it at $107, and now it's at $127. I make $20 per share. I have 200 shares. You know, I'm making money. And you see this RSI is hot, right? In your mind, what you're going to think when you log into your account and you see that you keep making money off of this stock, or the value of your stock is going up, in your mind, you know what you're going to tell yourself? That it's going to keep going up, right? Why would you sell it? You just watched it go up for 3 straight weeks or for 2 straight weeks. Why would you sell it, right? Like, it could go higher. It could go higher. So this is why people ignore the RSIs, because they're literally logging to their phone, watching themselves make money, right? So, so they see the RSI is high and they say, well, maybe it can still go higher. And then look what happens. Look what happens over here when you ignore the RSI, right? So what happened directly after the RSI got hot? What happened to the price of the stock? Y'all let me know in the comments. Exactly, right? So remember how I was saying that this strategy can fail you, right? The RSI could be hot up here, and then you can sell the stock and it can keep going and it can keep going. It's not foolproof, but you know, most of the time it's going to work for you. So if you sell at this date, you just locked in all your profits. Now all that money you made is yours. But if you were being greedy and you ignore this RSI, then you're going to watch all your profits just diminish. They're just going to slide out of your hands. You're going to see, oh, you were up $20 per share, right? And then the next day you were down and you're down and you were down. And you're just going to sit there and watch your account get smaller and smaller because you ignored the RSI, right? Is it because people sold their shares? Yes, exactly. So once people start selling, then the price goes down. It's all about supply and demand. So the price starts going down, and the more people that sell, the more people are going to sell because the price keeps going down and keeps going down. Okay.
And that's because you have to remember, when you're buying into the stock market, you're buying from someone, right? So if I know that this company IPHI, if I know that it's trending upwards and for some reason that it's popular amongst investors, I'm able to sell that. I'm able to sell the stock for a higher price than I would if the price was trending down.
Wait, we got whoever's making these, man, we set this up so bad. Whoever's making these annotations, how can you get these? Sorry, go ahead.
And so when the RSI is going towards 30 or below 30, that's going to trigger a buy sell in your mind, or a buy signal in your mind. That's telling you that the stock is now oversold. So people have sold the stock off and it's being oversold. At this point, it's good time for you to buy because the price is going to eventually go back up or go up to a certain point. It's kind of at the bottom when the RSI is near or at 30. Okay,
so just blindly following the RSI, right? Not worrying about the moving averages or anything, right? We have two extreme warnings here, right? So we have one here on this day or this period. We have one, right? This is like a 3 or 4 day window. And then we have one going on right now. So without looking at the moving averages or anything, just the price and the RSI, you see what happens, right? You see what happens when the RSI gets hot, the stock price fell. So imagine if you owned on this day, basically what you're looking for is somebody to sell it to. So you're saying, hey, the RSI is hot. So you're looking for somebody in the market to say, hey, bro, come here, man. Let me sell you this. Boom, you're going to sell it to him and you're going to get out. And then what happens? The price falls, right? So, all right, you know, the months go on, and then look what you have again, right? A hot RSI right now. So today I made a video about this, right? So I owned 22 of these shares. So when I woke up today, I checked the RSI and it was hot. So what am I going to do? I'm going to sell. We can make an educated guess that the price of this stock is about to go down, right? Based on the RSI. If we're wrong, it's okay. We got out, we locked in our profits. That's the most important thing. In the stock market, when you're trading, you don't make or lose money until you actually sell. So this is telling you, hey, bro, actually sell, right? We're going to talk about long-term investing. Long-term investing, it works different because if you're invested in this company long-term and the RSI is hot, who cares? right? The opposite RSI will trigger you more, right? So you can buy in more. But if the RSI gets hot and you're an investor, you plan on holding this for, if you plan on holding this for 5, 10 years, 3 years, it doesn't matter what the price did today, right? So if you're just strictly looking at the RSI, you would have sold here, you would have locked in all your profits and avoided that fall. If you sell today, then guess what? You're most likely going to avoid this fall. Now, let's say the RSI is wrong here and the price keeps going up and the price keeps going up. It doesn't matter. You locked in your profits. You have money in the bank now. You're not worried about the rest of this trade anymore. Okay. Yeah, we're speaking of trading right now. So if I have a profit and the RSI is hot, I should still sell even if it's a long-term hold. No, if it's a long-term hold, don't worry about it. Okay, let's see.
So what we're going over right now is simply indicators that are going to show you when to buy and to sell. If you're investing long-term, like I said, if you want to continue adding to those long-term positions, you still want to pay attention to RSI to give you those buy signals.
Yep.
So if you're investing long-term, you want to be buying more shares of whatever company you're investing into long-term when the price is the lowest, right? So that you can basically bring the average cost of your shares down, or if you just want to basically buy what you want to buy at the lowest price possible.
Okay, so let me see if I can.
Someone says, do I wait for the RSI to hit the 30 to buy? So the RSI doesn't always hit the 30 or go below 30. So you kind of have to, like I said, like these indicators, they don't line up perfectly all the time for every chart that you're going to look at. You kind of have to look at multiple of the indicators, and you also kind of have to look at the history of the chart. So for instance here, if I look at over a 6-month period, I can see that even when the price of Lyft is dropping down, right, and then it begins to trade sideways, the RSI never touches 30 or goes below 30. So if I'm up here and then it's rising and it goes down here, and I see that it kind of went to that same point, right, but it never goes below 30, I can kind of make an educated guess to say that this may be a good time to buy instead of trying to wait for it to go all the way down to 30 or below 30.
Okay, so I'm going to show you guys on the buying side, right? So somebody wants to see the parameters really quick. There you go. Simple moving average 20, simple moving average 20, and then exponential, we like to use 5. Okay. So when you go to the indicators, you want to set this RSI at 14. Okay. Okay, where and who do you sell to lock in the profits? Is it a website, or how do you advise? How do you advertise to sell your stock? You go into your brokerage account and then you just hit. You click on the position that you have. So you'll click Lyft, and then you'll go sell, and you could do a market sale, or you can do a limit sale. And we're going to talk to you about different types of sales, and you're just going to hit sell. You don't go find people to sell it to. The market does that for you. Okay. So, all right, now we're going to talk about the RSI being cold, right? So the RSI being hot is up here, 70, right? So you see back on June 8th, we'll call this June 8th. Look what happened to the RSI. It was at 70. It touched 70, and then look what happened to the price. It fell, right? You guys all see that, right? So if you would have ignored this RSI, guess what would have happened to your profits? They would have just slipped right out of your hands, okay? So now we're going to talk about the RSI when it touches 30. You see down here, it touched 30, okay? Look what happened to the price. So the price was at about $40, and then it started falling, and it fell. Look how long it took to fall, right? It went from June to the end of September. Okay, so on this day, this cold, windy day in September 28th, the RSI touches 70, right? It's being oversold.
30.
Sorry, it touches 30. It's being oversold. That's telling you that this price has went down too far, too fast. So that is your indicator to buy. So above 70 or above is your indicator to sell. 30 and below is your indicator to buy. Okay. Oh, sorry, October. Yeah. All right. So imagine you buy here on October 28th when the RSI touched the 30, right? So we'll call this price $21.50. Look what happens the next day. It starts going up, right? What if it keeps going down? This is why we're going to use multiple. Indicators, but we're just giving you a feel for the RSI. This is just us preaching the RSI to you before we throw it in and layer it with other indicators. All right. So look what happened when the RSI. On this day, the RSI touched 30 and then it went up. So if you would have bought in this day at $21.50, here you are a whole 4 or 5 days later, you're up to $31.80. So just that quickly, you could have made profits if you would have bought when the RSI went low and then you would have sold, right? But sometimes the RSI will be low and it'll just keep going lower and it'll keep going lower and it'll keep going lower, right? So this is when it gets cold. Another one that got cold. Okay, so look what happened here. In July, the end of July and the beginning of August, Intel, so they make, those chips, they announced that, yeah, I wish it always happened like this too. So Intel announced that they were going to be late making the chips that they needed to deliver, right? So all the investors got scared and they said, oh man, why are you guys how could you be late on chips? That's all you do is make chips and you're still gonna be late. So the investors start selling their stocks, right? So you see the price of Intel was about $60. And then the news came out and they said, we're gonna be late with our chips. So overnight, the price just fell and it fell and it fell, right? So it fell all the way down to $58 or $52. So that triggered a cold RSI, right? So just because the RSI is cold doesn't mean you want to sell, but we're just using the RSI strictly. I mean, just because it's cold doesn't mean you want to buy. I'm just showing you. Okay, so notice this RSI is cold, but it keeps going lower and it keeps going lower and it keeps going lower. But if you blindly just bought the RSI the first day that it was cold, look what happens. Eventually, the price comes back up, right? So it's just giving you a heads up saying, hey, this went too far, too fast. If you're an investor in Intel, if you're an investor in Intel and you're going to buy and hold this long term, then this is your opportunity to buy, right? It's a low price. Okay, so the RSI goes low. It goes low for a while. It starts going lower, lower, lower. It reaches its lowest point, and then what happens? It starts coming back up. As it starts to come back up, the RSI goes back to regular, right? So it gets up to this point, and then it starts falling back again. All right, so I actually bought Intel around here. I had my sister buy Intel around here. So we're just adding to our position. It takes a few months. So all of August goes by, September goes by. And look, Intel climbed all the way to $56. I feel good because I told, my sister, I'm like, yo, go buy Intel. They pay dividends. We're going to be good. They're making more money off of their service than they are for their chips. We're going to be good. So I'm buying, my sister's buying. I have one of my friends buy too. And then they have earnings, right? So remember we said that these companies have to report their earnings. So they report their earnings and their earnings were bad. They missed their earnings. So guess what happens, right? They fail and they fail again, they fail again. So if I'm a long-term investor, in which I am, here's another buying opportunity for me, right? So we're just showing you guys, the RSI is showing you how a stock can go from one extreme, which is overbought, and another extreme, which is oversold, right? Okay, so let me answer this question. From June 8th, after the RSI hit 70, it remained below 70, but yet it kept tanking. Is there an indicator that would have hinted for me not to buy yet because it's going to continue to tank. Because if I looked at the RSI, I might have bought in after the first tank, and it would have kept losing because it kept tanking until September. Okay, so yes. So you use the moving averages in conjunction with the RSI, right? I'm trying not to like jump over to combining them both first. I'm just trying to show like a skeleton version, right? But yes, basically what happens is even though there's an RSI that's hot, you don't want to buy the stock until it crosses past its 20-day moving average, right? So the RSI goes hot here, right? On this day, the RSI starts going hot, but look where the moving average is. The moving average is up here and the RSI is down here. So you're not worried about this stock right now. It's just on your radar because the RSI went hot. You're going to let it trade sideways or trade sideways and trade sideways. You buy when it crosses the 20-day moving average because that tells you it has momentum to go upward. So this is your actual day to buy, right? The RSI puts it on the radar for you. You know, yo, this price fell too far, too fast. And then it crosses the 20-day moving average. So this would be your true buying point here, right?
Close to closing before entering.
No, you can buy as long as the price stays above this, then you could buy. You don't have to wait until closing. Maybe when you wake up in the morning, it's there. If you're day trading, it'd make a drastically bigger difference, but we're swing trading. So as long as it's above its 20-day moving average, right? So what you want to do, guys, is combine these two indicators just to give you like an overview. You want to combine your RSI with your 20-day moving average. So when a stock crosses its 20-day moving average, that's a signal to buy, right? And the RSI makes the indicator to buy even stronger. So what I would do is buy here. Like if I was just going to try to swing trade this, I'm not an investor. If I'm an investor, I'm going to buy maybe a small chunk here, then a small chunk here, then a small chunk here, right? So I started buying around here. But if you're a trader and you're just looking for some money, you're looking for some quick money, then what you would do is buy your RSI or buy the stock when it crosses the 20-day moving average, right? And then it's going to run up. So at this price, it's $49 and we'll say $49.95, right? And it runs up here. So now you have a $3 profit per share. There's no indicator for you to sell it, right? So you could lock in those profits at $3 a share, or you could just hold on to it, and you hold on to it until the RSI gets hot again. So the RSI almost got hot here, but it didn't. So you would have, you'd be up in profit, but you're not selling. You'd sell when it falls below the 20-day moving average, right? Good. Yeah, good. So we're just, we're trying, this is what we're trying to do. We're trying to help the absolute beginners. The more comfortable we get with reading the charts, the easier it is to be combined indicators. Your Batman, RSI, 20-day moving average are just two tools for your utility belt. There are others you can use and combine. You just have to find what you like and stick with it. Yes, exactly.
That's totally right. And I think it's important for you to remember that all of these don't have to be perfect, and they won't be, you know what I mean? Like, this is not a perfect scenario where the price is going to be moving downward and the RSI is going to be perfect. It's going to be at 70, and then the MACD is going to be perfect, looking like it's going in a downward or upward trend. All of these don't have to align. For instance, let's just say, was it in March when all of the prices started to fall due to COVID? Mm-hmm. If you look at like the prices that were falling, like whatever day it was when the entire market started to tank, the RSI wasn't it wasn't like in a cold state because it was just an immediate drop. So if I was looking at the chart on that date, it wouldn't show me that the RSI is anything but what it was the day before. You know what I mean? I would have to wait until the next day for it to show that price, the actual price, or until the chart updated, basically to show that change in the RSI.
Let's see, where's March at? March is down here. So you guys, the RSI is set at 14. when you look at a daily chart. So if you pull back and look at a weekly chart, then you notice like the RSI never went hot. I mean, it never went cold, like it just went when we were showing you. So make sure that it's at 14 when you're looking at a daily chart. But this is what you were talking about.
Is that March?
Yeah, this is March. This is when the prices fell.
Okay, see, the price dropped drastically on that day. Like, that's the biggest candlestick out of this entire chart right here. There's no bigger change in the entire 6-month period than on this date right here. But if you look at the RSI, it's not even below 30. I think it was probably like, what is this?
No, it's because you're on the weekly chart.
Oh, it's because I'm on a weekly chart, but
Yeah,
you don't, so you don't have to, or if I look right here on this date right here, when RSI is right here, that doesn't show me an indicator that the RSI is like really low and I need to be.
It's not gonna match up if you have on the weekly.
I need to be selling. So you have to basically use your common sense and, as I said, look at the market sentiment, what's going on in the economy when you're looking at these different indicators.
Can you go to, let's check out. Okay, so you guys, our strategies are a little bit different. She uses the 5 EMA a lot more than I do, right? So this is gonna be up to you, right? This is going to be up to you whether you use the 5, you use the 20, or however, right? There's so many different ways to do this, right? We're just trying to give you guys like these tools, right? Okay, so for instance, here's Microsoft. Okay, here's Microsoft. I've been watching Microsoft for a while, right? But I'm not going to buy Microsoft as a swing trade unless it crosses its 20-day moving average, right? Which would have been when? Can you guys tell me when Microsoft crossed the 20-day moving average?
And upward or downward?
Upwards, going upwards. Okay, all right. Let me clarify this. All right, let's say I'm watching Microsoft like this week. You know, on Sunday, I'm doing my homework. I'm setting up my charts, and I'm saying I'm going to buy Microsoft as a trade. I'm going to start a new trade with Microsoft when it crosses its 20-day moving average. Right? When did that happen? It just happened today, exactly. Someone just said it, today. So, mind you, all right, so if I'm looking for trades, right? If I'm looking for trades and I have like a whole list, you know, like you guys see our whiteboards, and we're looking and we're saying, did this cross the moving average or not, the 20-day moving average or not, right? So if I had Microsoft on my homework crossing the 20-day moving average, and then I log in today and I see Microsoft cross its 20-day moving average, then it was today. Did I lose you guys? Okay. Please repeat this. Okay. Good. I'm glad that we're struggling through this all together. All right. So check this out. The current price of Microsoft is $216.39. Okay. The 20-day moving average for Microsoft is $213, right? You guys good with that? All right. Yesterday, what was the price of Microsoft? So if this is today, this candle is today, yesterday was here, okay? It was ranging from just below 204 to just above 205, okay? So if I'm watching Microsoft, so imagine I'm watching Microsoft and I'm saying my signal to buy Microsoft is when it crosses its 20-day moving average, right? Let's say I did my homework on Sunday, it's now Wednesday, right? My signal to buy Microsoft is when it crosses the 20-day moving average. I wake up in the morning and I see Microsoft is now above its 20-day moving average. You guys see that? The price is above that blue line. So now I'm going to buy. Got it?
Mm-hmm.
Okay, so we're going to run through like a few more of these. Let's go.
I'm going to show them MACD real quick.
Okay.
So we haven't covered MACD, but I just want to go over it with you guys before we continue on with these charts. So as I was saying, MACD is going to show you the direction in price movement or momentum. So we were saying that you can use this as kind of like an early warning indicator. And as I said, it's not perfect. It doesn't always align. But anytime your MACD is going to the negative side, that's showing you that the price of the stock is most likely going to be going down or in a downward trend. And if it's going to the negative side and it starts to heat back up to the positive side, that's the indicator that the price is going to be going upward. So I'm going to try to find a good position here where for instance, right here, right? So if we look at this part of the chart, can you zoom in? All right, so I'm gonna go back. Someone said they're still confused. So MACD, as I was saying, is showing you the difference in price momentum. So how fast are the prices going to be going up, or how fast the price is going to be going down, or it's showing you basically the direction of the price movement. And it can be used as an early warning indicator to show you if the price is going to be going up or down, whether the MACD is on a negative side of the scale or on the positive side of the scale. Let me know if you understand me to that point in the chat before I move on. Yes, okay, so there's a negative side for MACD and then there's a positive side. So when the MACD starts to, every single day, so there's a bar for every day, every trading day, there's a MACD bar that is associated with that trading day. And then we have, for instance, here, we're gonna go over here to the month of September. So here we have the MACD is shown right here. At the very top here, the MACD is on a positive side. It's very high on the positive side. But if you see on this date right here, it begins to cool off, right? It begins to go down, down, down. It's going to the negative side. That's when this large drop in price occurred. Yep, bars down are going to be negative and the bars going upward are going to be positive. So for instance, here we have the prices going upward here on the chart. The price is going upward. The MACD is going in an upward direction on the positive side. And if we can see, if we can just look here, right? If I look on this date where the cursor is right here, I can see that my MACD is starting day by day to go down to the negative side. That's a direct indication that the price is most likely going to start to trend in a downward position. And if I can pair that indicator with the indicators up here, my moving averages, this also tells me that the 5-day or the price is moving towards the 20-day moving average in a downwards movement. That gives me a signal that the price is going to be going down. Yeah, someone said you may not get everything the first time. They definitely had to study, and that's okay. Like, you don't have to understand all of this right now at this moment. We're gonna have a part 2, part 3. We're gonna have multiple parts. As I was saying, I want this to be like a progressing series. And you can always go back once this video is over. You can always go back and you can say, you can watch this video It's going to be saved to the Discord. You can watch it over, and you can take notes. And if you have questions, you can just go into the stocks chat on the Discord, and you can ask questions there also. MACD acronym again. I may have missed that. Okay, 1 second. I'll go because I can't remember exactly what every word means in MAC, because I just call it MACD, as most traders do. All right, so just remember that the MACD is showing the momentum for price direction, right? Either to the downside or to the upside. And you can use it as an early warning indicator that the price is going to start moving upward, or the price is going to start moving downward. But you kind of want to use it and compound with your other indicators, and compound with your RSI indicator, and compound with your moving averages also. So could you just set alerts for the moving averages? I'm not sure if there's a software where you can set alerts. I know that on stock charts, there's not an option to set an alert when the moving averages are going to be, when the price moves over the 20, or when the 5 EMA is moving over the 20 MA. Someone said Webull has it, so perfect. So if you have Webull, I guess you can set up alert there for to see when when your moving averages cross over each other. Or if you don't, I think it's worth it just to download Webull just to get that alert, even if you don't trade on Webull. Thinkorswim has it. Someone says E-Trade has it also. Why the candle different sizes on points random charts? Why are the candles different sizes on points on random ends? Oh, okay. So the candlesticks are going to be different sizes based upon how high or low the price movement swung. So for instance, on this trading day right here where the cursor is, this candle, the price only moved from this point to this point throughout the trading day. So this would probably be around 230, 233. And then the low point of the day for this candle would be around 228 maybe. So that means that the price just ranged from those two numbers throughout the day. On the other hand, if you look at this candle, it's a lot bigger. That's because there was a major drop in price. So the price was traded at the highest point at around 229, but it dropped all the way down here to under 220, looks like 218. So that's what creates the different sizes in the candlesticks. It's going to be the range of the price throughout that specific trading day. Yep, that's the high and the low price of that day. No problem. All right, I want to show you guys before we end. So those are the 5 indicators that we're going to use. Our RSI, right? 30 is your RSI being below 30 is going to prompt you that your stock is in an oversold state, and you might want to be on the lookout to buy it. The RSI being above 70 is going to prompt that the stock is in a overbought state, and you may want to be on the lookout to sell, right? Our moving averages, we have our 5-day, our 20-day, and then we have our 200-day. So I'm going to show you guys an example of how you can use your 200-day moving average. Let's see. What was the name of that company, the IPH company? The company that you sold? IPHI. All right, so it doesn't show it on this chart, but your 200-day moving average can be used as a form of support or resistance. So usually, let's just say if you had a 200-day, let's see. I'm trying to find a good example for you. SPY. All right, for instance here, right? So here we have our 200-day moving average, right? It's being used as a form of support, meaning that the price will drop down, but when it gets to its 200-day, it doesn't go below that. It literally drops down around here and then it bounces back up. And then you see here, it does the same thing and then it bounces back up because price has memory. So if it knows that if it went here, but it didn't go below here, you can bet that it most likely is gonna go towards the 200-day, but it won't go below it. So if I'm trading the SPY and I see that it's headed towards the 200-day, I can bet that when it gets closest to the 200-day moving average, or if it bounces off of it, that the price is gonna go up some. But it's not likely that it will go below it because this 200-day moving average is acting as a form of support. And it's not the same for every chart. Some charts that you look at, it will be like that. And sometimes the 200-day will act as a form of resistance also. So at the top here, where the price will go up towards the 200-day moving average, and then it will fall down. It will fall down. It will start being sold off. Does anyone have any questions about that? Price candle went above 20 MA today. Then that's a buy signal. Should we wait until the bars on the MACD start going up to the positive side before jumping in? Who's this Oddness Fly? What company are you talking about? All right, before we finish out this class, I want to show you that price movement for stocks is going to move in 4 stages. Update. All right, so there's going to be 4 stages for price movement for stocks in the market. Can you go back to the PowerPoint real quick?
Mm-hmm.
All right, so these are going to be the 4 stages of price movement. The first stage is going to be the accumulation phase or accumulation stage. And that's basically when the price is going to be trading sideways, or it's going to be bought and sold for around the same price for a couple of days or day after day. The next stage is going to be stage 2, which we call the breakout stage, or it's going to be when the price is going to be in an upwards trend. Right? That's the point. If you're trading stocks, you want to buy around this stage 2 phase. That's when your price is going to be breaking above the 20-day moving average, or when the 5 EMA is going to be trading above the 20-day moving average. Then we have our stage 3, which is going to be distribution. That's when the price is going to be trading sideways after rising. And your stage 2, the price is going to start trading sideways before it starts to be sold off. That's when your RSI is going to be reaching near or above 70. That's when you should be selling if you're trading to lock in those profits. And then the last stage we have is the stage 4. That's when the price is going to be in a downtrend. So that's after investors are realizing that the stock is oversold, that it's in a overbought, the stock is in an overbought state, and they're trying to sell it, right? Once the selling starts, the price is going to start to go down until it hits the bottom and it starts to trade sideways again. So the stages kind of start over. 1, it's going to be the accumulation. 2, it's going to be the breakout. It's going to go up. It's going to go sideways again. Stage 3, and then down is going to be a stage 4, the declining phase, and then it's going to trade sideways again, start over at stage 1. So as you can see, the price is only going to go up, down, or sideways. No other direction, up, downwards, or sideways. So you want to be buying in on the breaking out from stage 1 to 2, or you want to be selling at the top, stage 3 before it goes into stage 4. So if we go back, oh, this is an even better example. So this chart is going to be beyond meat, right? This screenshot was from, I think it was June or the end of May. It was from the end of May, but the chart is just set up so nicely. It shows you exactly stage 1 where it's trading sideways, and then it begins to break out. I would say that you want to wait at least 3 days of upward movement after your stage 1 accumulation before you buy in. So, because that's going to tell you that this is definitely a stage 2 breakout for this stock. So as you can see, after stage 1, the price starts to go up here. The 5-day moving average starts to trade above the 20-day moving average, and the price starts to go up. And then around January 21st, no, even before that, is that like the 15th of January, the RSI starts to heat up above 70. That's prompting us that we need to sell. We're at the top, right? We got in at the bottom as it was breaking out. We're at the top and we need to be selling. So I have the sell point circled there. Now, if you want to, you can continue to ride it throughout this stage 3 where you're in the distribution phase. But as soon as the 5-day moving average crosses below the 20-day moving average, what happens? Does anyone see that? When the 5-day moves below the 20-day after the stage 3, what happens?
Point to it.
Oh, how do I get to it? Tanks, right? It goes down. Can you see that on the chart? So the same thing happens if we go over to April, looks like April 7th on the chart. We can see that the 5-day moving average crosses over the 20 in an upward direction, and the price starts to go up. After trading sideways for a couple of days, it starts to go in an upward trend. So that's really all. Do you have anything to add or no?
So what you guys should know about the 4 stages of price movement is that they don't have to go in order. So it doesn't have to go 1, 2, 3, 4. Sometimes it'll go 1, 2, 3, 2. You know, like I guess we could just run through some charts.
You don't have, so if you're brand new to this, you don't have to fully understand everything right now.
Okay, can you quickly tell us what indicators you use for your Apple call today?
For the Apple call today, for the options, that's what they're talking about?
Yeah. You mind?
Sure. So options are a whole different world though. So I won't go too in depth with the option call today because the indicators that you're looking for when you're buying and selling options are, they're not the same as when you're buying and selling stocks, basically. So, but for the Apple call today, I was basically looking for a point where the price was low. And then I look for a price target, which was where price was previously at on that trading day. So that's how I called the strike price for that options call. I looked at where price was, and then I looked for a dip. So when I'm calling option plays, I'm looking for dips in the market, basically, for that trading day.
And then you're just going to use the price that it fell from as a strike price, like it will go back there. Okay, so let's say where was I going with this? Oh, using no, actually we're gonna have to, let's make that a whole nother video where we let's go deeper into the 4 stages of price movements on our next one, and then also support and resistance lines.
All right. So go ahead.
Sorry.
Go ahead.
All right, so we're gonna knock out some questions about like the basics. You guys got any questions? I know if you're brand new, which this is intended for people who are like really brand new. If you're brand new, like you're going to have to look at this stuff over and over again before you before everything comes together as one, you know. But at least, you know, I hope that you guys at least feel comfortable looking at a chart and going into stockchart.com and saying and seeing the chart.
Stockcharts.com, it's a website.
It's not an app, it's a website, so go to your Safari browser.
Microsoft, someone said it's now a good time to buy Microsoft. Is that the chart that you're looking at when it just crossed over the 20?
So if I were me and I was buying Microsoft, I'd buy Microsoft today because it crossed the 20, and then I'm gonna set a target at 225, right? So here was like a resistance line. I would draw a resistance line out here. So I would look to swing from 216 to 225, which will give me a $9 swing. If it should break 225 before it hits the 70 RSI, then I believe that it could go to this 230 area. Okay, so what's the minimum amount of shares you usually purchase? It depends on the price of the stock, right? So if you're going to trade, I would start with positions of, let's say, if you want to like start a trading account, maybe you could do $500 positions. So maybe you could do five $500 positions. So you could have 5 different trades going on at once. If you're going to invest, then whatever you can afford to live without, like Crystal was saying, so you never have to sell your shares to pay a bill or cover like a flat tire. What do you mean by positions? Okay, cool. So when I talk about positions, right, I might have 8 different trades going on at once, right? So each of those trades, I might refer to them as like a position, right? So I might be trading Microsoft the same time I'm trading Apple, the same time I'm trading Groupon, the same time I'm trading Overstock. So if I'm going to, let's say I'm gonna start off with $2,500 in a trading account, I can put $500 into one trade, $500 into another 5 times, right? Do you find yourself trading the same stocks repeatedly? How often are you finding and going into new investments? So do I find myself trading the same stocks? Yes, it's probably about the same 20, 25 stocks, because you start to recognize their pattern. I'll know every time, okay, I know every time Microsoft gets to this area, Microsoft is going to struggle with 216. This is how I know, because when it got here, it struggled with 215, 216. When it got here, it struggled with 215, 216. Right there, it broke it, and then it struggled again around here, right? So when I'm trading the same positions over and over and over, I start to realize a pattern. So I'm not always looking for something new. I just want to learn the patterns of specific stocks. So you can go in and out, in and out, in and out of the same positions, okay? There's a drip feature on Fidelity. That's it.
So what's the call?
Okay, calls and puts are options. We're not going to talk about options in this at all, but options are different than trading stocks. So when you hear somebody say a call, then they're buying the contracts, not the actual stocks. Are your profits still taxed when you have the drip feature turned on for dividends? Yes. What's the minimum amount of shares you would usually purchase? Okay.
Go up a little bit. So someone said on stock charts, what do you set the RSI and the MACD at? If you can you scroll down on your chart? So RSI is going to be set to 14 or 14 days. The MACD, your MACD is going to be set to 12.26.9, and it's going to, your chart should automatically generate those parameters when you open up your stock chart for MACD.
Yeah, it's my option webinar. If you go on my social media links, it's there. So trade is when you want a couple of dollars now, and invest is you saving for future money. Is that correct? Yes, that's a good way to put it. Trading and investing are two separate things, man. So you can trade Microsoft and have an investment in Microsoft. For you guys who are out there and want to trade and invest at the same time, create two separate accounts. I use two separate brokerage accounts. So I'll use one brokerage account for my long-term investments, and I'll use another brokerage account to trade, right? So I don't get them confused, and all of a sudden I don't turn an investment into a trade, or I don't turn a trade into an investment, because the way that you get in and out of these positions is going to be different if you're trading versus investing. So for example, if you have a trade and your trade starts working against you, you have a stop loss, right? So we'll use, let's say Microsoft, right? If Microsoft falls below $200, then I'm going to get out of this trade, right? So let's say I'm trading Microsoft. If Microsoft falls below 200, I'm going to get out of this trade. If I'm an investor in my investment account in Microsoft and Microsoft falls below 200, I'm going to go dump a bunch of money in because I believe in Microsoft long term, right? So there's different strategies when you trade and you invest, so you don't want to confuse them by using the same account.
Someone said, what's a DRIP? And that's in relation to dividend stocks. So basically, a DRIP is, as we said, like some of these companies, they'll pay you a dividend payout and basically a thank you for investing in our company. So DRIP is basically when you're taking that dividend payout and you're automatically reinvesting it back into that company. So however many shares your dividend payout can buy, it'll buy them at that time.
So let's say you're going to get paid out $30 in dividend and the actual stock is $30. Your brokerage account will automatically pay you out that dividend of $30 and buy you one more share of that stock. So it's just an automatic thing. They pay you out and then they grab a new stock for you. So then the next time you get paid a dividend, you're going to get paid a little bit more than you did the last time because you own more shares, and it's an automatic thing. Or you can let your dividends go to cash. So you could let that $30 hit your actual brokerage account, and then you can, either go spend it, or you could buy another stock or whatever,
So someone was asking about options. They said that they have all Chris's courses. Should they master stock market, basically fundamentals, before they jump into options? And yes, you definitely should. Options are a lot more riskier than buying and selling regular stocks, as we're teaching you guys about today. And you can lose a lot more money really quickly. The main difference between buying and selling stocks and then stock options is that there's an expiration date involved. So once your expiration date hits for an option, you can lose all of your money. It can go to zero, and you don't have an opportunity to wait for the price to go back up.
Okay, so I'll give you guys an example. Let's say on this date right here, when Microsoft is 215, and I make a guess that Microsoft's going to go to 235, right? And let's say it goes up to 225, and then it falls all the way down to 200. So I bought at 215, and now it's at 200, right, on this day. I'm down $15 per share, okay? And then it goes back up to 216. So in the matter of from the beginning of October to November, I went from being up a few dollars here to being down a few dollars here, and then being up $1, right? All that took place in a matter of a month, right? It went up, it went down, it was a roller coaster ride, but now I'm up $1 per share, right? With an option, you won't have that that luxury. Once it works, once the option starts working against you, you either have to sell right away or you're going to lose 99% of your money. So that's why you have to master the basics here before you move over to options, because you could lose 99% of your money and you can't wait for it to come back up.
Okay, someone said, so do you buy and sell on stock charts? No. So as I said at the beginning of the video, what you want to do is you want to sign up for a brokerage account. So I use TD Ameritrade. Chris uses TD Ameritrade also, and E-Trade and Webull. Some people use, what is it called, Robinhood, but I wouldn't really recommend it. So there's a bunch of different brokerage accounts that you can use to trade. So you basically transfer money from your bank account to your brokerage account, and then you transfer the money then from your brokerage account. From your brokerage account, you can buy and sell stocks.
So boom, you go to TD Ameritrade, open new account. Okay, and then it's just going to be an individual account. Open an individual account. Okay, and then you're just going to fill all this information out. And then you're going to fund this account with money from your bank account. And then you can buy and sell shares from there. I recommend I change from Robinhood to TD Ameritrade. Yes, I don't recommend anyone using Robinhood. If you want to use Robinhood, go for it, but I don't recommend it. The problem with Robinhood is that there's no customer service, right? So let's say something happens with your money right now, right? You can't call Robinhood and tell them something. Let's say you had $3,000 with Apple, and you've seen that somebody just logged into your Robinhood account. They sold all of your positions in Apple. Now they're about to transfer. They're about to transfer that $3,000 to their bank account. They took your bank account out. You just got hacked, basically, right? You can't call Robinhood and be like, "Yo, someone's trying to steal my money right now." You're gonna have to send them an email, and they'll respond to you in like 6 days, right? I could call TD Ameritrade right now. So if you're gonna give somebody your money, you should be able to call them, right? If your auntie was holding $5,000-$10,000 from you and you need to know what was up with your money, you should be able to call her. If you can't call her, she can't hold your money, right? Mm-hmm. I can't call Robinhood, so Robinhood can't hold my money. So that happened to somebody. Somebody broke into their brokerage account. They sold all $20,000 worth of their investments, and then this person was sending that $20K to their bank account, right? They hacked in, changed the banking things, and changed it to their bank account. So the guy noticed it. He emailed Robinhood, and he's like, "Yo, someone just sold all my positions. They're trying to steal my money." 6 days later, Robinhood's like, "Oh, hey, thank you. We just got your little thing. Like, we'll give you a call sometime." You know, like they don't have a live customer service, right? So I don't like that. If I can't talk to you, you can't hold my money. That's basically the number one like rule. If anything were to happen like that, all of these accounts could be hacked. Your actual bank account could be hacked too. But best believe you can call your bank and be like, "Yo, somebody logged in and did this and did that, and I didn't authorize it," and they'll shut that shit down. So the fact that you can't speak to somebody makes Robinhood a no-go. And then also, one thing you guys got to learn too is when you're trading options or something, right? And let's say you're getting ready to sell option because you see that the price is tanking on the stock, right? And you're like, it's tanking, and you go to sell, and the brokerage account glitches, and it makes you log out and log back in, and the price is just falling. So now you went from being minus 5% in your position to minus 60% that quickly, right? And the reason why you lost that money that quickly is because their app glitched. You know what they're gonna tell you? They can't do nothing for you. You know what I mean? Like, so this happens with all these brokerages, but it happens a lot more with Robinhood. Yeah. So you just don't want to take that chance where you're trying to hurry up and sell something or hurry up and buy something, and then it glitches out on you, especially if it's going to cause you to lose money, right? Because they're going to say, "Yo, that was in the terms and conditions." All these companies have it in their terms and conditions. The difference with Robinhood is it happens a lot more. So you can't call them, and they're likely to glitch out on you. earlier this year when the stock market fell, it was starting to recover. The stock market had the biggest single day, positive day, green day in, I think, like in 30 and 40 years. And guess what happened to all Robinhood's traders? Locked out of their accounts, right? So if the stock market was tanking and you're buying puts because you think it's going down, and you wake up and the stock market's having the best day in the last 30 years and you can't even sell because you're losing money because you can't log in, Robinhood's gonna be like, I can't do nothing about that, bro. Like, that's on you. So it happens too often, and there's no live customer service. Bull is good for beginners, by the way. If you're holding long-term options, can you use the same strategy like stocks? Kind of. Yeah, if you're gonna buy in the money because something crossed the 20-day moving average, you're gonna buy in the money call. It'll work for you. Is there a charge to transfer from Robinhood or a percentage? The fee to get out of Robinhood, I mean, the fee, yeah, to transfer out is usually $75, but this is what you do. You call TD Ameritrade or you call E-Trade and you say, oh, hey, my name is Chris, and I have a brokerage account with Robinhood, and I was calling around to see, where I can store my money, invest my money. And they say, oh yeah, well, we have an individual brokerage account for you, blah, blah. And then you'll go, do you guys cover the fee? And then they're going to say, yeah, we'll cover the fee for you. Boom. Now you just got out of Robinhood for free. If you can't, and they don't want to cover that $75 fee, pay the $75 fee, right? Mm-hmm. Pay the $75. I'm telling you, paying the $75 fee to transfer your account out of Robinhood is way better than, you getting jacked for some money or you losing money because Robinhood be acting up. So
yeah, I've seen multiple times. I was showing Chris this. I think I've shown you this at least twice already. Where on Robinhood, what they'll do. So we haven't covered this yet, but you can set a stop loss, and that's basically a price that you want to sell your shares at, no less than that price. So let's just say if I buy shares at $220 and I don't want to lose no more than $5 on the shares, and I can set a stop loss at $215, right? But I've seen Robinhood do like a glitch where the stock price will go down. Let's just say it was $230 to $190, and then it'll come right back up. It'll be like a
instant, like 3 seconds.
An instant glitch. But what that's doing, because the stock market is like it's an electronic marketplace, so it's prompting a sell signal for all of those stop losses, because the system is just recognizing for 2 seconds that the price went below this price. The price went below this point. So
it'll force you to sell all your shares.
So it'll force you to sell all your shares. And even if the price starts to go up after that, you've already sold.
Yeah. Well, she showed me that like a few times actually. If you call TD Ameritrade, they will reimburse you. There you go. So, okay, another thing. If you guys have Robinhood and you want to get out of Robinhood, you don't have to sell all your positions. So if you have $3,000-$4,000 invested in Robinhood, $20,000, however much you have, you don't have to sell it and then wait for it to go cash and then transfer it. You literally keep all your positions. So whenever you log into TD Ameritrade, they're gonna say, how do you want to fund your account? Do you want to fund it with a bank account? Do you want to fund it with a debit card, or do you want to like import an account? And basically, you're going to import that account, right? So you're going to put your Robinhood account number, your routing number, whatever account information they give you, and they're just going to go to Robinhood and snatch your account and put it with them, right? So most of them will cover that $75 fee for you. I'm calling Robinhood. I'm calling E-Trade. Yeah. So I want you guys to know this. Any of these accounts can get hacked. Your bank account can get hacked. Like, cybersecurity is something crazy. But for you to be able to call somebody and be like, yo, $500 is missing. Mm-hmm. Like, isn't that more comfortable than, like, you log in and say, oh yeah, $500 is missing, I don't know where it went, versus sending someone an email and they respond 6 days later.
Yeah. And like you said, I use TD Ameritrade, and you have to realize that all of these platforms, they run off of the server. So sometimes you can just simply have issues with your server on TD Ameritrade or E-Trade or Charles Schwab, whatever brokerage account that you're using. Sometimes the server can have issues, or the server can be down. There was one time I was trading back when I was like day trading, and there was a glitch. I couldn't get into my account onto your mirror trade, and by the time I got back into my account, the price had dropped, and I was down like $20,000. And
Just
I
like
was
that.
pissed. I called them and I'm like, what the heck? Like, I need my money. I don't know who's gonna pay me back my money, but somebody's gonna pay me back. And I still, although I was down like $20,000, I still couldn't sell. So it was just going down more and more and more and more and more. But the good thing about it is the gentleman that I talked to on the phone, he was able to tell me like, okay, if you want to sell it right now, I can do it for you. There's not a feature like that on Robinhood. You can't, like you said, you're not going to be able to call anyone. So if I wanted him to sell it for me, and eventually he did, the price eventually went all the way back up. And I think I took a loss of like $1,800. And he was able to sell the option for me.
So yeah, being able to talk to humans, man, is like, yeah. And if you literally like just go Google Robinhood, what's the craziest thing about Robinhood is the interface is so perfect. It makes everything super simple, right? So when you log in, everything is just nice and laid out. I don't think anybody has a nice interface like Robinhood does. It looks clean, it looks smooth, it looks up to date, but that shit's all a gimmick. So stay away from Robinhood. All right, you guys. I know we are long-winded tonight. We're trying to get everyone up to standard. I mean, up to like speed. So you guys know what we're talking about when you hop in those group chats and you're like, okay, I know what a moving average is, or I know how to find it, or I know what the MACD is. I know what they're talking about, the RSI. We're trying to bring everyone up to speed, you know. So that's our job. So we might have a few long-winded ones, but we want to make sure that everybody is learning and growing with us. So eventually, once you get comfortable with the terminology, you get comfortable looking at charts, you get comfortable with this, eventually we want to get you to the point where you start making money with money. You know what I mean? Like, because, and this is just me ranting, but we're from the beginning of time, we're only taught to make money with labor, right? Like you can go to work and you can, you know, work for $30 an hour and you got to put in 8 hours. Somebody at home on their computer took $3,000 and made as much money as you were going to make working for $30 an hour, but they made it, you know, in an hour or two in the stock market while they were at home, like chilling. So the point is, nothing against work or anything like that, but the point is we were only taught to use labor to make money when you could use money to make money. Same thing with dividends. You know, if your money is sitting in a savings account, like I was explaining this to one of my friends. Think about how many like grandmas, like think about like how many of our grandmas probably saved because they've been working their whole life, or their grandpas, they've been working their whole life, and they got $180,000 put away in a savings account. They just saved their entire working life, right? Like they didn't take no risk or anything, and they got $180,000 saved from 45 years of working, right? Had they put that money in the stock market, they'd be a multimillionaire, right? Mm-hmm. And the difference is they didn't take the time to learn that stuff. They just got the money and stashed it, put it in the savings account or whatever, you know. But you know, you take $180,000 over 40 years, compounding at or earning 10% a year, and you got a few $1,000,000. And that's the difference with, you know, grandma and grandpa leaving you with 200, 300K, and your cousins and your brothers with, you know, a little bit of money, or just having enough money to, you know, pay for the funeral and maybe, you know, pay off the house or whatever. So this information is life-changing, man. And like I said earlier, you could build up these portfolios and then you could pass them off to your children when they, you know, when they die, like the dude who his great grandfather was invested in Coke. Like that's what's crazy. So you got to think, man, I'm 29 years old. I have an Apple phone. The chances are my children will have Apple phones and their children will have Apple phones too. So if I'm buying Apple now, what's Apple going to be worth in 30, 40, 50 years, you know? And I turn around and pass that off to my kids. So so yeah, I just want to spread the information, but it starts with like knowing what the hell is going on, being able to look at a chart and say, yo, okay, I can see what's going on. I see why people are saying I should buy this or I should wait, or everybody online is talking about, because I really got mad at all these people that were just saying, oh, buy Apple, buy Tesla, buy Apple, buy Tesla. Like it's people who just, you know, preach this like generational wealth. They just yap their mouth, but they didn't even look at a chart to see that the RSI was screaming like, yo, don't buy me. Don't. I'm going to show you guys, actually. I'm about to show you guys because you'll see this when everybody starts talking about a stock, there's a really high percent chance that you've already missed out. So watch this.
And there's a really large chance that when everyone thinks that something is going to happen, it doesn't. For instance, today, prime example, people kept saying like, oh, the stock market is going to tank on the day of the election.
And now it's running.
And it's super green today. I mean, like, and it started yesterday.
All right. Can you guys see this? So look, check this out. Can you guys see this? All in August, people were telling people, yo, go buy Apple, go buy Apple. And I'm not knocking it because people make a bad call. I've made plenty of bad calls in the stock market. But to simply ignore this hot ass RSI because you're trying to tell people, yo, just because you have an Apple phone, but you don't have no Apple stock. Like, yes, bro, they have an Apple phone. They don't have an Apple stock because it's not the time to buy Apple right now. You should have been yelling this like, for the people who were pretending like they knew what they were talking about, you should have been telling people to buy Apple right here in March, right? It crashed in March. That was the time for people to buy, right? But anyway, so people are sitting around online and everyone was talking about it. Yo, buy Apple, buy Apple. The RSI is hot. And even though the RSI was hot, the stock kept going up. So people would come to me and say, yo, Chris, should I buy Apple? And I'm like, no, bro, the RSI is hot. But the next day it goes higher. And the next day it goes higher. I understand that I'm missing out on money by not being invested too, but I don't care because I'm going to stick to my strategy. And then what happens? The day that the stock splits, the very first day that the stock splits, that was the end of that. That was the end of all the hype. That shit just went straight down, right? That shit just went straight down. Everyone's talking about, oh, it split. This is your opportunity to buy. So on September 1st, everybody bought. And look at that. The market was telling you don't buy it. The indicators were telling you don't buy it. So everybody who bought on this day at 135. So imagine if you bought, 10 shares and it went from 135 down to 105. So now you're down $30 per share times 10 shares down $300. You bought 100 shares down $3,000. You bought 1,000 shares, you're down $30,000, right? Something you could have simply avoided, So there's going to be like a lot of talk and stuff like that. People like throw out these ideas, and I need you to be able to go research something on your own and not even listen to me. Like if I say, yo, go buy this, you need to go look on the chart first. If she said, yo, go buy this, even though she had a lot of success with options and I had a lot of success in the stock market, like you still need to be able to chart this. So I need, I didn't build the wealth squad for me to tell people what to do. I'm trying to educate people. So when your grandma is saying like, yo, go buy this right now because everybody's talking about it, you like, nah, like that's not cool, right? So another thing too is listening to the news, right? So I want you to realize something. These people who sit on the news and they talk about stock this and this is going up and buy this, I really want you to think about this. If they knew what the hell a stock was going to do, would they work for the news company? Right? Like if I knew for absolutely, like I was certain that this stock is about to go up, I would just go bank everything that I have on this. And I wouldn't be working for the news. I wouldn't be a news anchor. You know what I mean? Like these people don't know what they're talking about. They're just reading something that somebody else wrote. So the news misleads people, right? And the news only gets all the information after the fact. And then people mislead people. So if you learn a strategy and you learn how to read charts on your own and you learn, what these different things are, you can empower yourself. All right, that was long. I'm done ranting, y'all. So I appreciate you guys for sticking in. I know this is long, but
I know.
We trying.
Sorry.
We trying, y'all. We trying.
The thing about the stock market is you need to have a good understanding, and I think like that's why it's so important for us to try to explain to our best abilities because, like Chris said, you will get clapped. Like if you don't buy and sell at the right time, you're just gonna be out here losing money. And I think for a lot of investors, that's what it was like when you first like jump into the stock market. There was no one to sit down with you and tell you, hey, use these indicators, look at a chart. You just think like, oh, I shop at Target. Let me go buy some Target shares.
Not knowing Target had a hot RSI and you was about to be waiting 8 months to get your money back because you got clapped. So,
but you don't have to do that because you can, you know, follow these strategies and buy and sell at the.
Damn, bro.
Dang.
Yeah. So a cool thing too is once you guys learn this, the stock market is going to go on 5 days a week every year, man. 5 days a week, you know. So you just continuously get better and better and better. Mm-hmm. So this is what happens. Money compounds and so does knowledge. So you go through a whole year, and the first year you make $4,200 in the stock market, and then the next year you make $15,000 in the stock market, and then the next year you're at 30, and now you have an entire source of income where you're like, man, I've been trading in and out of the stock market. I'll be trading on my lunch break. You know, I buy in on this day, I wait for a few weeks, I sell, you know, I pay my little taxes. I'll make an extra $40,000, but you have to have the knowledge first because it will empower everyone, especially like, you know, this year when the stock market collapsed. I made 6 figures in the stock market like 2 months after it collapsed. And I'm like, this is crazy, man, because there's so many people in the world that will never even make 6 figures. And I'm like, because I knew what to do, I didn't panic. You know what I mean? Now I'm like, I want to show everybody how to do this. I want to show everybody, like, when everyone's panicking, you can run to the opportunity, you know? How you pay these taxes. When you go into your brokerage account, it's going to give you a form. And that form is going to basically, your brokerage account is keeping track of everything that you make and profit and everything that you lose. You can write off up to a certain amount of your losses too. So I think it's like up to like $3,000 of losses in the stock market, you can write it off. But they're going to give you a form. The same way your job gives you a W-2, like they're going to give you a form, and then you hand that to your accountant and you say, all right, this is a rundown of how much I made, how much I lost in the stock market. So, all right, y'all, we're gonna dip. So we'll let you guys know when the next class is. Go back and rewatch this. Like I said, you're not gonna learn all this stuff on the first time, on the second time, on the third time. You literally gotta watch this shit for hours.
And if you set up a brokerage account, you can simply like YouTube. If you go to TD Ameritrade, you can YouTube how to buy and sell on TD Ameritrade. And there's so many videos. Even TD Ameritrade makes a learning video on how to buy and sell an option on that platform. And it's the same thing for every platform. There's videos on YouTube that will tell you how to set up your account, how to use the account, how to buy and sell.
Yeah. All right, y'all. We'll catch y'all.
Good night.
Peace.